Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Brad Smith. And here are three things that you need to know this morning. Earnings season's in full swing, and the next big tests come in the shape of Apple and Amazon. The analyst community generally bullish on the iPhone maker ahead of its numbers. Apple stock has soared by nearly 50% this year, headed into its report Thursday after the close of trading. Over at Amazon, cloud will be a big focus, especially after Microsoft said it sees demand for its Azure unit continuing to cool. The results season overview, meanwhile, the beats are piling up. According to FactSet, 80% of S&P 500 companies have reported a positive earnings per share surprise so far. As for the road ahead, 27 of the index's constituents have issued negative earnings per share guidance up until this point. Investors have not been rewarding the beats as generously as they were last time out of course, so surpassing expectations, not always enough to get a share price pop this time around. And we're watching the next steps for central bank policy. The ECB has not ruled out another hike, and the Bank of England is poised to raise its benchmark rate in the coming days. Then, of course, there's the Fed. The central bank's next steps are unclear ahead of the September meeting. The FOMC is perhaps not as aligned as investors would like. We're going to speak with the man at the more dovish end of the spectrum. The Chicago Fed's Austin Goolsbee will be joining us this hour.
Well, second quarter earnings season is well underway, and big tech giants Amazon and Apple, they are set to report their latest financial results later this week. So far, tech earnings have matched the hype. This quarter, there's a big emphasis on advertising spend and euphoria surrounding generative AI. But with Wall Street bullish on tech again, investors are wondering just how long market momentum can last. For more on the tech industry, we're joined by Mona Mahajan, who is the Edward Jones Senior Investment Strategist. Mona, great to have you here with us this morning. Let's start there in this larger kind of tech trade and the focus on tech that we've seen, especially coming into this earnings season with some of the larger trends here. Is, from your perspective, tech delivering on expectations, and what does this set up for later this week?
Yeah, it's a great question. And look, the Nasdaq is up over 35% year to date. Clearly, technology broadly has had a great run already. Now, what we would say is this is a pretty nice setup for tech broadly, and especially large cap tech. Not only are you seeing inflation trends move lower, interest rates over time potentially moving lower, but we're also seeing a lot of these large cap tech companies have free cash flow available. So they don't have to go to the markets or banks to borrow at these higher elevated levels of interest rates. So this is a good setup for large cap tech broadly. And then, of course, you have the cherry on top, which is the start of what we think is a secular bull market in generative AI. We are, of course, seeing that reflected in the markets in a very quick manner. What we would say from a trading perspective, these stocks have run very far, very fast. Would we expect a period of consolidation, some profit taking, perhaps a pullback? That is, of course, a natural part of any sort of business cycle and market cycle. But what we would say is, for those that haven't positioned in technology after this, or maybe missed the first half of the year, any kind of period of volatility we think is an opportunity to position for this longer term trend. Now, valuations are on the stretch side. So we do think that waiting for better opportunities could be interesting here, but we do think that the trend is here to stay, and we think that the backdrop will be favorable in the months ahead as well.
Mona, it's Julie here. It's good to see you. What about valuations, though, for these tech firms? Because, yes, you can look at the sort of longer-term generative AI story, but in the meantime, these guys are expensive. Does it just not really matter right now? It hasn't seemed to matter for a while.
Yeah. Look, I think the growth trade was the one that worked for the first half of the year. As we look towards the back half of the year and early into 2024, where we are seeing better valuations is in what we're calling the S&P 493. Outside of what we're saying the Magnificent Seven, or the 7 large cap tech trades that have really led the rally thus far. Now, valuations, for example, in the 493 are about 16.5 times forward PE versus about 30 times in the Magnificent Seven. So you're seeing this discount in the rest of the economy and the rest of the market. So where we do think, one of the key themes will lie over the next 12 to 18 months is a broadening of leadership. And so, and that could probably be driven by an economy that's holding up better better than expected, a Fed that's potentially moving to the sidelines. But where we do think you want to be positioned is a balance of not only the tech trades, but you want to make sure you have exposure to areas that do perform well in a recovery environment. That includes cyclical sectors like industrials and materials. That also includes small cap stocks, which have started to show leadership as well. So to your point, technology does deserve a part of your portfolio, but really you want to make sure that the theme of your portfolio for the next 12 to 18 months is balance, and making sure you have some of the cyclical parts of the market, even international and small cap, as we noted, good places to be as we go through the rest of this cycle.
Mona, we've been looking for bellwethers out there, and this week perhaps we have even two, but from your perspective, is there a bigger bellwether in terms of this earnings season? And we've got Amazon and Apple to both kind of put into that conversation and into sight.
Yeah, thus far this earnings season has delivered, similar to the first quarter where we came into earnings season looking at very negative growth rates. I think we came into this earnings season looking at about negative 9% or so. We're about negative 7.5%. 80% of companies that have reported thus far have beaten on bottom line, so margins are holding up better than expected. And as we're looking through full year earnings, in fact, the S&P earnings growth for this year, it's now slightly positive. It had dropped to slightly negative. So, not stellar earnings, still about flattish for 2023. What we think is really interesting for earnings is 2024. And thus far, expectations are for a rebound in 2024. In fact, to double-digit levels, so about 12% expected in 2024 earnings. So you're looking at a backdrop where earnings could grow, inflation could moderate, as we noted, and the Fed could not only step to the sidelines, but perhaps start thinking about rate cuts next year. So that's an environment you want to be positioned for as we're heading towards the back half of this year. And again, periods of volatility, whether it's around earnings or otherwise, we think that is the opportunity then to position, especially as there is a lot of money still, we think, sitting in shorter duration CD, cash-like instruments that has yet to be deployed into the markets. And so there's an opportunity, we think, still ahead of us.
Right, and we'll see when that starts to sort of tip over or pivot, if you will. Mona, hang on for just a second here because we want to really concentrate more on the central bank conversation. Central banks are still very much in focus this week. The ECB has not ruled out another hike. The Bank of England's poised to raise its benchmark rate in the coming days. And then, of course, the Fed's next steps are unclear ahead of its September meeting. The FOMC says it's more data dependent than ever and not necessarily as aligned among its members as investors would like. Division between the so-called hawks and doves has become more prominent in the last few months. We're going to speak with one of the more dovish ones in just a bit. The Chicago Fed's Austin Goolsbee is going to join us in moments. Let's get back to Mona, though. Edward Jones, senior investment strategist. So as we look ahead to the Fed, you were just started to talk about what we could see going forward. I do want to pick up on what you were saying, though, about where investors' money is right now. We have seen a flood of money go into things like money market accounts. People have been trying to take advantage of this higher yield environment. When do you think that is going to change? When do you think that the messaging from the Fed will become a little bit more clear on the next steps and investors will start to rethink that position?
Yeah, look, on the Fed, they will be reluctant to declare any sort of mission accomplished too soon. And so we do expect their rhetoric, at least, to remain somewhat hawkishly tilted in that, the threat of another rate hike is always kind of imminent. But that being said, we've seen some of their projections back in June. They did release an economic projections that also showed where they think the Fed funds rate will be in 2024. And that was 100 basis points lower than where they saw it in 2023. And so when we think about it, this year we don't anticipate any sort of rate cut or perhaps even a discussion of a rate cut. But as we head towards the end of this year and early next year, could the Fed start at least signaling a potential for moving rates lower? We do think that's feasible, especially if inflation continues to moderate And when you think about rates at 5.25% to 5.5%, very much above what the Fed would even consider a neutral rate, which is probably closer to 2.5%. So if they don't need to remain as restrictive, they could start to think about at least gradually moving rates back towards a neutral level. But we'd say more broadly on the CD and short-term money opportunity, yes, it's been attractive year to date as rates have moved substantially higher. You're now able to lock in 5.5% or so on short-term money. But as we head through the next 12 months or so, one, there's reinvestment risk there. The yields remaining at these levels probably has a shorter window at this point, maybe the next 6 to 12 months or so. But secondly, for those investors that have concentrated on cash-like instruments, have deviated from kind of their strategic asset allocations in equities and bonds, you could miss some of the opportunities, and perhaps you've already missed a little bit of the equity opportunity, but some of the more interesting opportunities that are forming in both equities and bonds. So we would say over the next 6-month period or so, one, think about extending that duration. We think longer duration will have a very interesting opportunity, especially ahead of a big inflection point like a Fed pivot. And two, make sure that your allocations in equities and bonds remain aligned to kind of your long-term goals. So you want to make sure, especially in equities, as we talked about, that you have some exposure to the AI trade, but you want to also make sure you have exposure to the broader market leadership that may emerge. So interesting opportunities, we think, in both equities and bonds still ahead of us. And for those that are sitting in the cash-like instruments, they actually have a great opportunity to complement or start deploying some of that into the markets. Inflation
is far off of where we were even a year back from now. And so the Fed's policy, it has been effective to a certain extent. And now we think about what that next leg is going to look like if they are continue to move the inflation more towards their target goal without perhaps throwing a rift in the stable part of their dual mandate in the employment situation. What are the ways that they could go about doing that without us risking a harder landing than the soft landing that we're currently forecasting or experiencing?
Yeah, it's a great question, and probably one that is the one that everybody has their eyes on. Can they continue, or can we continue to see lower inflation without meaningfully raising the unemployment rate? We do think that the unemployment rate may migrate gradually higher, but we don't see a historically sharp rise in unemployment rate, maybe in line with what we've seen in past recessionary environments. We think the unemployment rate is probably headed towards a 4% level or so. But really, the number of job openings is still quite high. Jobless claims, while they've started to move higher, haven't really seen a sustainable trajectory. I think still in this labor economy, employers are holding on to valued employees, thinking that it will be difficult to rehire if they do go through a layoff cycle. So I do think some of the distortions we've seen through the pandemic are really kind of playing a big part in this labor market. People have left the labor market, they haven't yet returned. We've seen excess stimulus and savings and how that's impacted a lot of labor market participants and consumers broadly as well. So this labor market has been quite unique versus any time in recent history. And I think the strength of the labor market really can kind of continue to provide the U.S. economy with some sort of cushion to avoid a very hard landing and maybe even avoid, a soft or more than soft landing as well. But we do think, generally speaking, labor market, the unemployment rate can rise, but not to levels that we've seen historically. So probably in line with the Fed's forecast of 4.5% or lower. And inflation can continue to moderate through that period.
Yeah, tough job the Fed has, even ahead of it. At this point, I'm pretty sure if any of us saw that job requisition open, we would not be applying or hitting the apply button. Stay with us, Mona. We've got a little bit more to discuss here, and let's kind of shift more broadly here. Economic data out of the U.S., China, and the Eurozone have surprised recently, with GDP from the U.S. and Europe growing more than expected in their respective second quarters. For the world's second largest economy, things are mixed, with July manufacturing PMI beating estimates while remaining contracted and the services sector missing expectations. In an effort to help stimulate the economy, China's top economic planning agency, they released policy this morning focused on removing government restrictions on consumption. So what do these efforts say about the global economy? Let's put that question to our guest, Mona Mahajan, who is the Edward Jones Senior Investment Strategist. So what does this say about what they're actually seeing within the economy in China, which was said by the IMF at the start of this year to be one of the two nations that would contribute the most to global GDP growth, and in the face of what has actually played out in it kind of lagging or being lackluster compared to expectations?
Yeah, this has been kind of a curveball that nobody saw coming at the beginning of the year. There was a lot of enthusiasm and optimism as China reopened from its lockdowns. And really, a lot of that has been a disappointing reopening. And we're seeing that play out in the economy, the PMI numbers we just received, but also broadly, consumption and economic growth has come in below expectations in China. Now, perhaps, the one silver lining or hope there is that we are starting to see the Chinese government and really the central bank move pretty rapidly to provide some support and stimulus. So, of course, the Chinese central bank is one of the few major central banks in the globe that is moving in the other direction. They're cutting rates rather than raising rates like the rest of the global economies and global central banks. And also, we're starting to see more talks about stimulus being provided to a lot of the state-owned enterprises there and a lot of the regional businesses as well. And so we do think while the Chinese economy has stumbled a bit through this reopening process, the stimulus measures are now being put in place. And we do think over the next, call it 2 to 4 quarters, we'll see stabilization in China and probably a resumption of some, healthier growth patterns. So if anything, probably setting itself up to be an interesting opportunity broadly. But thus far, the Chinese economy being weak has weighed not only on the Asian region, but Europe as well as a pretty big trading partner for China. So we've seen their growth, probably not be as robust as it could be because of some of the weaker growth in China as well. So, broadly speaking, we do think that we're probably at a trough type level in China, probably going to see better data ahead of us. But it is, going to require a little bit of patience over the months ahead. But thinking about that from a portfolio perspective could be interesting, especially from an EM trade.
Mona, what's also interesting is you mentioned that the effect that it's having elsewhere in Asia and on Europe, it seems to have had less of an effect on the United States, right? Yes, we have had some U.S. companies that have said that China growth has been lackluster, but largely our rally's been just fine, right? So I wonder if things do improve there, just like the downside has not affected us that much, will there be much upside here from upside there?
Yeah, it's a good point. The U.S. is a bit removed actually from the Chinese economy than really it has been in recent history. It's not a large trading partner. And of course, we're hearing more about onshoring and moving away from the Chinese supply chain and manufacturing as well. That will take some time, but that is a direction of travel. So to your point, the upside that comes from the Chinese economy stabilizing and moving higher, probably more felt in the Asian and European regions and probably will be reflected in those markets as well. So, we do think more recently we've seen the MSCI EFA, for example, non-US developed markets and EM lag the S&P 500 and of course the Nasdaq broadly. But as we go through the next few months and we think about inflation globally coming down, we think about a stabilization in the Chinese economy and a recovery, Europe and even the US over time, maybe going through some sort of soft patch and recovering from that as well. Mm-hmm. That's a good setup for global investments broadly and EM in particular, especially if in that environment the dollar continues to soften a bit. And so what we'd say is when we think about a recovery basket, we talked about cyclical stocks, we talked about small cap stocks. We would certainly include some EM and international exposure there as well. We do think the environment is setting up for a better recovery play in the 12 to 24 months ahead.
Interesting stuff. Mona, thank you so much for spending some time with us this morning. Mona Mahajan is Edward Jones Senior Investment Strategist. Thanks. All your markets action coming up. Stay tuned. You're watching Yahoo Finance.
On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from 30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. Well, the Federal Reserve raised rates for the 11th time last week, just before receiving a cooler inflation report on the Fed's favored inflation gauge. Wall Street thinks the Fed should be finished raising rates, but policymakers see one more rate hike before the end of this year. So how much more work is there left to do? And a first on Yahoo Finance, I want to bring into the program President of the Chicago Federal Reserve, Austin Goolsbee. President Goolsbee, it's great to see you. Thanks so much for joining me.
Yeah, thanks for having me back.
So you voted to raise rates again last week, and since then, we've gotten a reading on your favored inflation gauge, core PCE, showing an easing in inflation for the month of June, sort of echoing what we saw with the CPI report for that same month. And we also got some cooler wage growth data for the second quarter. So taking this data together with last week's rate hike, how restrictive do you see the policy rate now?
Well, it was fabulous news to get inflation, to see that inflation's coming down in this way. And it's important to note there's different ways you can view inflation, and we tend to look backwards over the last year. But the new information, of course, is just the monthly reading, and the monthly readings have been coming in quite good. So our goal is to stick on what I call the golden path, which is let's get inflation down without causing a major recession. And that will be a triumph for the Fed, a historic triumph. It's very seldom happened that way. We've never been able to get inflation down even as much as we've gotten it down so far without a recession. So the restrictiveness of the policy rate, we're gonna have to play by ear, and we'll get several more major data points before the next meeting, but it's looking like we're walking the line pretty well.
Okay, I want to come back to that in just a second, but before that, last time you and I spoke back in May, you were worried about the early innings of a credit crunch. We're now more than 4 months since the failure of Silicon Valley Bank, other regional bank failures. How do you view credit conditions now?
So far, that's been the dog that has not been barking. So we've seen a stabilization in the bank sector. We've seen money coming back into bank deposits. Whenever you get a rate tightening cycle like the one that we've experienced, where we're up 500 basis points, in 15 months, let's call it, that will mean tighter credit conditions. But so far, we have not seen anything tighter on the credit conditions than what you would expect for such a tight rating cycle. So that's been heartening to see.
Okay, so you mentioned things are looking pretty good on the inflation front. You got that better PCE number, the better CPI number. The dog hasn't barked, like you just said, on credit conditions. So how much more work do you see left to do to really bring inflation down from here?
Well, that's the key question. Thus far, I think we have been disproving the folks that have let's call it a stable Phillips curve in their mind, that the only way to get inflation down is to crank up the unemployment rate and engineer a recession. And there are a great many economists who have been arguing that. The last 6 months have proven that wrong. And the stable Phillips curve idea was kind of broken before there ever was COVID. And now we're coming out of COVID and it's broken again. And as I say, two brokens do not make it fixed. I think let's follow the data. And this business cycle was so sufficiently strange and sufficiently unusual that I don't think that the normal rules of a direct trade-off between unemployment and inflation necessarily have to apply. They certainly have not applied in the last 6 months.
So to your point, given the resiliency that we're seeing, does that still allow you for more room to do one more rate hike later this year?
I don't know. As you know, Jennifer, I'm not a fan of tying our hands before we get the data. We still have months before the next meeting. I will say thus far, we're on the golden path. And we got to walk that line. We're going to stick to it. But that effort to get inflation down thus far is working. And if we can do that without generating a major recession, that's a big achievement for the Fed.
You've been a fan of moving more cautiously. Do you feel it would be prudent to skip the September policy meeting to allow for more time to collect data and then decide whether you would want to raise rates again later in the fall?
I don't know. It's a hypothetical. We're going to get multiple important observations about both inflation and the job market between now and September. And I'm open to reading the data. If there's a major change of conditions, I haven't made up my mind for what should happen in September. But this golden path, which so far we're sticking on that line, that would be a triumph, and it's certainly a possibility at this point.
Certainly a possibility to skip September or to stop raising rates if you have enough good inflation by September.
As I say, all of the above. There's nothing off the table. There's nothing specifically on the table. Let's not tie our hands of what we're going to do before we get the information. So far, we've gotten inflation down without a recession, and indeed without even raising the unemployment rate, a thing that many economists said was literally impossible. So let's keep our eye on the new monthly inflations in core, both goods and services and housing, because the goods inflation, we've seen nice progress. Housing is now supposed to start dropping. The housing inflation is supposed to start dropping as we get the market rents kind of flowing through into the way the index is calculated. And anything that we're getting in the near term reducing services inflation is in a sense just an added bonus, because we have not thought, we have always thought that to be the stickiest part of inflation. That we've seen actually some progress on that front was unexpected and a nice bonus.
So in order to move into that extended hold, if we were to get a couple more readings on core inflation similar to the last couple that we received, would the data suggest stopping?
Well, you saw the median SEP at an earlier Fed meeting, And I will just point out the market expectations about rates are pretty similar to what's in the S&P, even a little less aggressive. And yet the market expectations of inflation are firmly anchored right around the target. And that's what you want on the golden path. And it doesn't forecast a major recession to do that. And that will be a triumph. If we get to that and we come into September on the golden path, I think everybody will be feeling good about where we are.
All right, so maybe that could have marked the peak then if we continued on this golden path, then it sounds like. Then kind of looking ahead, eventually as you look to hold rates for some time at certain elevated levels, as inflation comes down, how will you judge whether the policy rate has become too restrictive and needs to be trimmed?
That's super important. That's the balancing act of walking the line, is that once you find the golden path, you got to stay on it, and you got to just keep monitoring the new information. Now, I've seen a lot of people trying to emphasize wages, almost treating it like it's a leading indicator for price inflation. And the only thing I will observe is that historically it's not at all. Wages lag price inflation. They're not a leading indicator of it. So I would caution everybody, don't make too much about inflation prediction when you see what wages are doing. It's more like what's happening to price inflation today is the indicator of what will happen to wages 6 months from now.
All right. And then before we wrap up, I do want to get your thoughts on the proposed capital requirements last week from Vice Chair of Supervision Michael Barr. How do you think that these capital proposals will impact lending as well as liquidity in capital markets? And do you think that they could address some of the problems that led to the downfall of Silicon Valley Bank and other regional bank failures?
Well, Jennifer, as you know, I'm a long-time advocate of high capital in the entire financial system, but especially in the banking sector. It's not the role of the regional banks to set policy. That comes from the board in D.C. But I will say that in an environment like the one we're in, where we've raised rates quite a lot in a short period, anything you can do on the macro-prudential side to strengthen the banking sector and keep it resilient and prevent financial crisis, that's a big win. It's important that we do that. At the same time, we're trying to navigate this golden path of getting inflation down.
All right, President Goolsbee, we'll have to leave the conversation there. But thank you so much for your insight as always. Look forward to speaking with you soon.
Yes, thank you, Jennifer.
That's Austin Goolsbee, President of the Chicago Federal Reserve. Julie.
Jennifer Schonberger, thank you so much. Austin laying out the golden path there. We'll see if the Fed can indeed navigate that golden path successfully. We just had the opening bell on Wall Street. Let's do a quick check of the market sponsored by Tasty Trade. We have the rally continuing here. The Nasdaq, which had big gains on Friday, continuing with its upward trajectory in a much more modest fashion, up just 1/3% today. The S&P hanging on to a gain of about 1/5%, and the Dow just up by the skin of its teeth, if you will, up by about 30 points here this morning. Brad Smith's favorite expression, so I'm going to send...
Yeah, between that and a hair's breadth.
Hair's breadth, that's the one that you love. I don't even know what well, hair's breadth, I know what that means. Skin of its... I don't know. I got to look... I'm going to Google what the origins of that phrase are.
Hair's breadth, skin of its teeth, hair of a chinny chin chin. Either way, we're seeing some slight gains here out the gate for the Nasdaq Composite. That's up by about 1/4%. You mentioned that skin of its teeth move that we're seeing in the Dow Jones Industrial Average. And I pulled up the 1-month chart here just as we close out this month of July. Take a look at this monthly move that we've seen during the month for the Dow. That's up by about 3% over the course of this month. Additionally, the Nasdaq Composite and the earnings season that has ensued during July, really powering some of those tech names here. That's up by nearly 4%. The S&P 500 over the month of July as well. That's up by about 3%. So solid moves here as we close out this month of July 2023 here. And we've got some more earnings that are set to come to really kick off August as well. But for the S&P 500 here on the day out of the gate, you're seeing that up by about 0.1%. So we'll see exactly where things net out here on the session. Let's take a look at the 11 S&P 500 sectors here. This is a 2-month look. I'll give you an intraday just so you get kind of the sense of how things are moving this morning early in trade. As of right now, pulling up the caboose, you've got healthcare. That's down by about 0.7%. Staples also lower by about 0.2%. But let's take a look at some of those leading sectors here right now. Energy and financials. Energy off and to the races. Had a good weekend, having a great Monday. It's up by about 1.6%. We'll continue to watch that move as we move on throughout the rest of today's trading session here and close out, as I mentioned, July. Did you know we're wrapping up July, Julie? Yes.
I had noticed.
Yes.
Meanwhile, escape by the skin of one's teeth apparently has biblical origins.
Oh, wow.
But it still doesn't make sense.
All right. We didn't talk about that one in church yesterday, so I'm going to have to go do some Googling myself.
All right. In the meantime, let's get to something that we know more about. SoFi. Those shares are climbing higher this morning to their highest level, in fact, since March of 2022, up 17% after reporting a narrower than expected loss and beating on revenue in the second quarter. The fintech company also seeing personal loan origination volume rise by 51%, student and home loan demand sliding. And we're going to be hearing from SoFi CEO Anthony Noto at about 11:30 a.m. Eastern, so stay tuned for that. In the meantime, let's talk about these results a little bit. The company's seeing a big increase in its membership count, which now stands at over 6 million.
Yeah, and for SoFi and the net member adds of 584,000 that get them to that quarter end total members, you mentioned that up 44%. New product additions of nearly 847,000. Their quarter end total products are up 43% year over year, that eclipsing 9 million, 9.4 million there. And then their total deposit growth here, this is an interesting highlight as well that's worth tracking. That growth came in at $2.7 billion. That is up 26% during the second quarter to over $12.7 billion, and they're raising their full year guidance also here. So you're seeing shares of SoFi positively reacting on both of these, the announcement of the earnings here, but on some key stats and metrics that they track and investors keep a close eye on to see what the health of the growth of their business looks like and whether or not that can be sustained over a longer period of time too.
Yeah, it's interesting here. The company's saying they are now offering FDIC insurance of up to $2 million. So most of their deposits are now insured, and they saw a big increase in deposits. So just they keep sort of broadening their business, if you will. But I'm really curious to hear what Nota's going to say about lots of stuff, including the student loan resumptions and the effect that's going to have on their refi business.
It's been top of everybody's mind. Looking forward to that conversation.
Yes, me too. Let's talk about Wayfair as well. The stock got a big upgrade from Piper Sandler this morning, and it's now higher. It was much higher, actually, up by more in pre-market trading. Now it's only up by about 2%. This as Piper Sandler's raising its rating to overweight from neutral, its price target getting a big boost all the way up to $97 from $35 previously, citing improving sales and share gains. And we have that note from the analyst over there, Peter Keith, who says, overall, the home furnishings industry does seem to be stabilizing, and that a supplier feedback on the company has been become the most positive in more than 2 years.
Yeah, significant move year to date for Wayfair, and it's all the more noticeable given the environment that Wayfair is in right now, and many of the home furnishing companies that are still looking to see when consumer demand for some of their products and for some of those SKUs that they're trying to work through, when that will shift. You've had a lot of changeover within this industry, though, over the course of even the past few weeks, with Overstock.com purchasing the intellectual property of Bed Bath & Beyond. We'll see what further changes are to come from that, how that also shifts the consumer perception of this industry, too, as it seems like a period of discounting could still be very much in the cards, at least for this near-term period of time, as they're trying to both work through inventory and at the same time make sure that they're continuing to engage with consumers that have pulled back some of that discretionary spending on home furnishings, as evident through the most recent earnings results from companies like Target and Walmart, who have cited that category specifically as some of kind of the low or lackluster areas.
Yeah, and the analyst over here also pointing out that the stock is still cheap versus pre-COVID levels. That's one of the other reasons that he's looking at this stock. You mentioned Overstock as well as, another barometer in this industry. We're going to be speaking to CEO Jonathan Johnson tomorrow about this whole, among other things, about the transition, right, in the brand name there. So we'll see how they are stacking up against the likes of a Wayfair and whether he is seeing some of the similar trends that this Piper Sandler analyst is seeing when it comes to Wayfair.
Absolutely. Some big movers this morning. We've got one more for you here. Let's talk about some good earnings news. On Semi, they reported second quarter results with profit rising, driven by growth in automotive and industrials. Its revenue did remain flat year over year as demand has stabilized. This is the first of a few chip maker earnings this week. We have AMD after the bell tomorrow, then Qualcomm later in the week, and then of course we are looking ahead to the big dog, NVIDIA, on August 23rd. So far, the sector has shown signs of recovery, partially thanks to AI hype phase as well as some return in demand here. So that's the full chip earnings on deck that we're laying out for you. Take a screenshot, take a photo, do whatever you have to do, or just tune in as we kind of hit all of those in stride.
Yeah, and it seems like what analysts and investors are really looking for at this point is signs of the bottom. Because while you have NVIDIA on one side of the spectrum, that's definitely not been the case and the story for all chip makers, where they are really seeing, and this is not unusual for chip makers, they see big cycles in demand, big shifts in demand over time. So whereas we had an Intel talking about maybe some signs of the trough in the PC cycle, right? But different areas of the spectrum here of chips on Semi, still seeing strong demand in automotive, for example. So we'll get a more complete picture as we get these dribs and drabs of all the Semi earnings.
And maybe Qualcomm will be the true telltale, as well as what we already heard from Intel, as to whether or not the PC bottom has been set in at this point, too.
Yeah, I mean, Qualcomm is at this point, I think, more reliant on smartphones, so it should give us some good insight into that area also.
Facts. All right. Well, all your markets action straight ahead. Stay tuned. We've got some exciting news on the other side of this short break. You're watching Yahoo Finance.
Mike Wilson of Morgan Stanley has been bearish for quite a long time. And in a note, he just said, we've been wrong. Now, I'm not going to ask you about what he said, but I am curious, like, in a strategy making role, just quickly, how often you sort of re-examine your assumptions?
Constantly. Every single week we meet together as a group and we check in on how our thesis is playing out, new data. The trick is there can be a lot of noise day to day. So really the trick is really figuring out what's the actual signal, what has actually changed, and not getting whipsawed week by week. But indeed, we have gotten new information over the past quarter that has changed the view. The first is the enthusiasm about artificial intelligence and how that's for real and can boost valuations in advance. And then also in terms of the macro picture, we do believe that soft landing odds have risen given the data we've gotten recently.
On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from $30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance. The narrow 2023 rally started broadening out 2 months ago in June. And with the latest surge in July, some interesting stats are popping up as to what cards the rest of the year holds. Let's head on over to the New York Stock Exchange, our very own Jared Blickery. He's holding the cards down there on the floor. Break it down for us, Jared.
Don't talk to me about concentration. I want to go straight to the Wi-Fi Interactive, where I have the sector action for today. A couple sectors in the red, looking a little defensive there. But let me just put a 2-month, and we're talking about the June-July period here. Retail, consumer discretionary, that is XOY, that's up 14%. Close on its heel is materials. Then we got industrials, energy, financials, communication services, which houses some mega caps. So you put all of that together, that's a pretty broad-based rally. And I have another way of showing that as well. If you take a look at this, the farther you are to the right here, and this is the Dow components, you got Caterpillar, that's up over 25%. The better the performance over June and July. The farther you are up, the better the performance January through May. Now we got Salesforce at the very top, they're up almost 70%, but it really hasn't done much since June, so that's why it's up there at the top by itself. Then we got Microsoft and Apple, not the best returns, but I think most people in Apple will take a 10% return, a little bit less than that for Microsoft, but just to show you, there are a lot more issues that have caught up and are trending this way to the right, which means better performance over the last 2 months than the prior ones. Then you take a look at the overall market, what the S&P 500 has been doing through July. I took a look historically, what happens when you're up by double digits, as we are now, about 18% in the S&P 500, and guess what? Really good results. Only one negative year, that would be 1987. So tailwinds definitely favoring the bulls here with respect to the S&P 500. Here's the Nasdaq. We got about 2/3 positive, but we do have a lot more red years, so not quite as bullish for the tech-heavy Nasdaq, but you put all this together and we're looking at some pretty strong tailwinds for the rest of the year. Anything can happen, and tailwinds like this, seasonality, only account for about 1/3 of the price action, so other factors, of course, can dominate. We could get a hot or a weak inflation print. But I think another thing that's happened recently that we need to pay attention to, which could upset these returns, is what is happening in the bond market. And here's the 10-year T-note yield. Last week on the news that the Japanese had potentially lost control of the yield curve there, our 10-year marched right back up to 4%. That's almost where it is right now. We start surging higher and the market starts repricing in a more hawkish Fed than is already priced in. We could definitely see equities take a stumble. Finally, here's the US dollar index. This goes back 2 months, and you can see after dropping through the support level, it was pretty quick to the downside, and we spent the last part of the month, the last 2 weeks or so, climbing back up to that resistance line. But in general, a higher dollar, bad for stocks, a lower dollar, good for stocks. Not exactly that black and white, but you get the picture there. So if the market were to roll back over like that, that would be very supportive for stocks. If we head back higher here, could be a little bit of a stumbling block. I would expect if that happens, if we get that stronger dollar, that would happen concurrent with higher yields and the market pricing in that higher for longer, even higher for longer Fed. But not getting too far away from ourselves right now. It's just looking pretty bullish from here. Even this big red candle, that nasty red candle that we got last week, well, that is being overcome as we speak, guys.
All right, well, we'll see what ends up happening next. That's always the fun of it. Thanks so much, Jared. Coinbase Chief Executive Officer Brian Armstrong revealing that the crypto exchange received more than a Wells notice from the Securities and Exchange Commission before the agency sued the company for allegedly ignoring requirements to register with the SEC. According to the Financial Times, the SEC asked Coinbase to halt all trading in cryptocurrencies aside from Bitcoin. Coinbase's Armstrong said the inquiry would have solidified, quote, an end of the crypto industry in the U.S. This as the crypto exchange prepares to report earnings after the close on Thursday. Of course, crypto is a lot bigger than Coinbase or even Bitcoin. For more on the state of the industry more broadly, we're joined by Matthew McDermott, Goldman Sachs Global Head of Digital Assets. So, Matthew, first of all, thank you so much for joining us. We really appreciate it. You guys have been investing in a number of different areas of digital assets and blockchain, for that matter, and tokenization. You've covered a lot of different parts of it. But I want to ask you very broadly, the regulatory framework, particularly in the United States, what effect that has had on your thinking about how and where to invest?
Look, a very good question. And firstly, thank you very much for having me. I think from our perspective, we are a geographical team. We've got presence across the globe. And so we've tended to just really kind of think about where we can progress the business. And as you kind of highlighted at the onset, there are many different facets to what we do. There is the tokenization and digitizing of the life cycle. There is the collateral mobility, where we're really thinking through how we can re-architect the financial plumbing of the market. Cash-settled crypto products obviously play into kind of a key part of the business. And so really, we work very closely as a regulated entity with our regulators and have identified, areas that we really can use the underlying technology to move the business forward. I think it's quite obvious when we look at different geographies, look at Europe, for example, the markets in crypto assets directive that was approved a couple of weeks or 3 or 4 weeks ago in Europe is a good example of certain jurisdictions probably moving a little quicker than others. We also see Singapore, Switzerland, and even Hong Kong moving at a greater pace, from a regulatory perspective.
And so even with all of that in mind, where does Goldman Sachs remain the most bullish on cryptocurrency as a whole? Do you believe that the worst of the crypto ice age is behind us?
Yeah, I tend to think about it kind of digital assets more broadly, and we've probably not been more excited in terms of what we can think about doing across the financial market with the underlying technology. And so there, we've got a large number of different projects that we're undertaking. We've developed our own digital asset platform, for which we've just recently won an award, which is great. So we really think that the market, just more broadly, be that the sell side, the buy side, the FMIs, feel a really kind of interesting and transformative impact of that underlying technology. And there's no kind of coincidence that you suddenly started to see more digital asset teams and strategies emerge globally across all of these different institutions, as they've all come on the kind of similar journey to me from 2020 right through to today. And that regulatory landscape that you touched on right at the beginning, has evolved in that time as well. And we've just seen, kind of regulations, like I said, across those geographies be either kind of progressed to be enacted or in progress. And so that really provides confidence, which encourages investment. And so you then think about, why do people do this? Look at the commercial drivers. And once you start to think about how transformative this technology can be in terms of digitizing that life cycle, making it more efficient, that whole speed of settlement. We did a transaction, for example, for the European Investment Bank, where the typical kind of settlement cycle is T+5. The transaction settled in 60 seconds. The digital asset platform for native digital asset issuance, for example, can be the authoritative source of truth. So you just remove all of the frictions in and around reconciliation. So you're starting to see the kind of the art of the possible. Similarly, when we think about this whole re-architecture of the financial plumbing, which sounds pretty grandiose, but really looking at those intraday markets, repo, securities finance, we've only got a foretaste of what this technology can do today, and it's already quite transformative. We operate in a macro backdrop where capital and liquidity proficiency is really key. And so that ability to use the precision of the technology to really kind of showcase how these markets can be transformed is hugely powerful. And people who've been on that journey recognize that.
So Matthew, just to take a big step back for just a second here, because I think most of our audience, most of the way that lay people have understood crypto and digital assets writ large over the last, call it 10 years, has been through something like Bitcoin, has been through cryptocurrencies specifically.
Absolutely.
What you're talking about is really infrastructure, effectively, right? How would you, in the simplest terms, sort of explain what you're talking about and where we are in that life cycle?
And I think a really good way to do that, actually, is to think about how that journey has taken place. So kind of in 2020 to 21, you had a huge swathe of those traditional financial institutions looking at Bitcoin and Ethereum and just trying to work out, given the sudden appreciation in the pricing of those cryptocurrencies, what does this mean for their business? How can they be more actively involved? And you found a lot hugely interested by the developments, and there's been some exceptional development in those markets. But seeing how that underlying technology then could really transform their own businesses, and seeing how you could apply that to financial services. And it's that application to financial services that really has caught the imagination, like I say, of a good cross-section of the financial markets, the buy side, the sells, the FMIs. And it really can, at scale, have a transformative impact. We're at such a nascent part of the market, but the trends are really moving positively.
So if I'm a retail investor watching this show and I say, I want to take advantage of this either as a platform or as an investor, I want to know what companies are using this because I'm excited about it. How would they go about doing that? I mean, obviously, you work for Goldman Sachs, and Goldman Sachs is doing that, so that's an example. But how would they also apply it as they look around?
I think it's a really good question. I think the retail kind of driven this marketplace. I mean, cryptocurrencies, as you said, was a key driver initially for people really focused on this. And I think the regulatory clarity that you see there, I think will now encourage more of the traditional financial players to enter the market. And so that actually provides a much sounder and safer market, because you have people who know and understand regulations be more actively involved in the market. With respect to tokenization, you're starting to see with some of the fintechs this kind of fractionalization of asset classes. And so over time, and I do think it will be time, you'll actually see a greater opportunity for that cohort to invest in different asset classes than they otherwise wouldn't have access to today. And the seamless nature with which information can become more transparent really does kind of aid that whole investment decision making. So I do think, from a retail perspective, a retail investor perspective, is probably something that will kind of evolve over time. But I think it really will be quite powerful on the forward. From point in time is, no.
I was just going to kind of layer on and ask from your perspective, what is the relationship right now between, and in your acknowledgement of retail investors having driven so much of the early days and the ramp up of crypto or digital currencies to the point where institutions had to take notice and had to create offerings and had to create technology as well that could then scale it up even more? What is the continued relationship between kind of both sides of that within digital currency, where you've got that retail side that's looking at large banks and saying, well, they've got way more money to throw around at this than I do. However, at the same time, you've got the larger institutions that are trying to figure out how they don't miss out on the fervor and the demand of this digital currency environment right now.
Yeah, I think retail kind of obviously was the kind of, they ignited the interest and kind of intrigue in and around the technology. As that technology has, matured and continues to do so, because like I said, it really is kind of at a very nascent stage in the context of institutional adoption. It's that technology that really has kind of opened the eyes of the art of the possible in terms of applying that to different financial markets. So cryptocurrency in itself is obviously a specific kind of part of the market. Actually seeing how that underlying technology can improve the way things operate today in the financial markets has been very powerful. There's a lot that needs to happen before we get significant adoption, but I think it's that kind of opening the eyes and that transparency in terms of what the technology can do that has truly kind of, I think, ignited that institutional interest and investment and focus that we see today.
Matthew McDermott, Goldman Sachs Global Head of Digital Assets. Thanks so much for taking the time here with us today.
My pleasure. Thank you for having me.
Certainly.
Thanks.
Everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Where will CPI be a year from now?
Well, I think if we were going to almost play the game of base effects, like CPI was flattered this June because of last year, we hit the peak. Maybe a bit higher if you get a bit of a stabilization in commodity prices and energy prices, and then you don't get as much relief on some of the stickier parts of inflation. But I think for the most part, hopefully we'd be stabilizing, but we haven't been focusing on that as much. And as you and I have talked about a lot, the Fed hasn't been focused on that either. They've been focused on other metrics that have been a little bit slower moving to the downside. So I think it ultimately depends, in my view, on the labor market, how strong wage growth is. If we do start to see a little bit of a loosening, if you don't, you probably have a scenario where you're a little bit of a higher inflation plane.
It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're about 30 minutes into the start of trading. Let's take a look at how stocks are moving this morning. First, taking a look at the S&P 500, you can see stocks looking for some direction as investors await lots of new data. This week, we've got the jobs report plus a whole heap of earnings.
And taking a look at individual stocks, Adobe shares are popping today. They're at about an 18-month high, in fact. Morgan Stanley said the company is rallying and still has further to go. The bank now giving Adobe its highest price target on the street at $660. That's about 25% upside, fueled by optimism over its artificial intelligence strategy.
And Archer Aviation stock, that is soaring today, flying high, some might even say, up over 16% on news that the company made a $142 million deal to build 6 of its Midnight electric air taxis for the U.S. Air Force. This is part of an existing partnership with the Air Force Agility Prime program, with the aim to potentially provide an alternate to helicopters for personnel, transport, and rescue operations.
And we continue to watch Palantir, the stock extending gains from Friday after Wedbush analyst and friend of the show, Dan Ives, initiated coverage of the company with an outperform rating and $25 price target. He called it the Messi of AI, as in Lionel, saying it's poised to be a major player in its new tech revolution.
Well, we have a heap of data and earnings to look ahead to this week. Our very own Josh Schaefer here with us in studio to break it all down. Hey, Josh.
Yeah, Brad, we're going to start with the economic calendar here. Not quite as exciting as last week, but still some things to be excited about here, right? So we got job openings tomorrow. That will kick off a big week for the labor market and updates there. And we're also going to have the S&P Global's reading on manufacturing PMI and services PMI this week. One trend we have been following there is, of course, services have been a big driver of economic growth, while manufacturing hasn't. We saw that trend start to maybe reverse a little bit with services declining in some recent reports. So that's one thing we're going to be watching out for. But really, of course, guys, this week, the headliner is Friday. It's jobs day. A big read on the labor market. Right now, there's expectations for 200,000 non-farm payroll additions. For the month of July, unemployment expected to stay flat at 3.6%. And a real reason we're interested in this story, of course, is because the job market has been one of the key things driving the economic growth we saw through the second quarter, and people are now projecting into the third quarter. So we'll be looking to see if we get any signs of a slowdown on Friday.
I feel like we need like a meter for your calendar excitement every week over earnings. So where's the Josh-a-meter on the earnings?
I would say this week, when we take a look at this early earnings calendar, I might be more excited than last week. This might be peak excitement. I don't know. I'm pretty excited. When Apple and Amazon report on the same day, does it get better than that? And not included here on that Thursday is also DraftKings, which, as you guys know, I follow very closely. So that's a fun Thursday. But also we're going to get an update from Starbucks on Tuesday, a little read on the consumer, and also Uber, which I think will be interesting to see what's happening with the food delivery business. But again, really the highlight of earnings this week, guys, is going to be that Thursday read. You have Apple and Amazon, really two good looks at the U.S. consumer as far as how people are ordering on Amazon, of course. And then Apple, are people still buying iPhones? Are people still buying iPhones at that premium level, or they may be trading down? Where are things at with Apple's services business? There'll be a lot to break down on Thursday. We'll have it all for you, and also Friday morning.
All right. I'm excited too. Thanks, Josh. Appreciate it. Well, recent heat waves have put renewed attention on the call for clean energy sources. When discussing the energy transition, electrification, solar, and wind often dominate the conversation. What about nuclear, though? The 3 Mile Island incident in 1979 and then the Chernobyl disaster in 1986 have largely turned public opinion against nuclear energy, not to mention Fukushima, which really set back some nascent efforts to bring nuclear energy back. In Europe, France is the leader in nuclear power and has pushed for it to be recognized as a viable low-carbon source. In Germany, Belgium, and Austria, they're all among countries in opposition. Germany has been moving away from nuclear power ever since that 2011 Fukushima disaster in Japan. In the U.S., a new nuclear reactor is opening in Georgia for the first time in 30 years. And President Biden has also announced plans to preserve clean nuclear energy as part of the 2022 infrastructure bill. That includes about $6 billion to keep up facilities and maintain jobs. Our next guest published a recent note on the future of nuclear energy in a low-carbon world. Joining us is Arkady Gavorkian, who is Citi commodity strategist. This is a really interesting part of the clean energy story, Arkady. And there are some new technological developments in nuclear as well. Are we finally going to see sort of a new moment for nuclear energy in the United States?
Yes, and thank you for having me. And this is actually what we argued for. We consider last year, 2022, as a landmark in nuclear energy, where policies start to catch up and technological advancements that's been happening in the last decade plus has been coming to the final stages of the design and potentially being connected to the grid by the end of this decade. This is the report or the analysis that we provided is looking broadly on the nuclear energy and looking at the fission and fusion side of the things. Even though fusion energy has been debated or anecdotally commonly compared as the energy that we'll see in 20, 30 years away, we think that's the thing of the past. And we think that fusion energy might be also coming for the commercial scalability by the end of next decade in mid-30s.
So by when will fusion energy be commercialized, do you believe?
It's really hard to give a precise kind of estimate, but we think that during the next decade, during 1930s, that's when some of the companies would have a potential kind of breakthrough and potential capabilities to bring the fusion energy and be connected to the grid. So, but before fusion, we actually think that new developments in nuclear energy on the fission side, mainly SMRs, would be prevailing and would be leading the way and actually starting this decade and potentially being connected to the grid in the different parts of the world, in Western and Eastern Europe, as well as in North America, Canada, and United States.
Typically, when you think of these projects, you think of them as very costly. And I don't think of the utility industry, the power business, as super profitable, right? It's steady, right? Dependable, throws off dependable cash flow. Is the paradigm going to shift when it comes to nuclear in terms of the profitability of where investors should be looking?
And I completely agree with you, Julia. The cost structure is still not in favor for SMRs, but there have been several studies, and obviously first of a kind prototypes or designs would be at the same level of the cost structure as a large new builds. However, as the scalability comes into play, as more and more reactors being produced, the SMRs should cost half or even more than half of the large new builds. We expect that this trend will continue, and this is something that also would depend on the type of the reactors that are being produced. So there, in nuclear, there's generation 3, generation 3 plus, and generation 4. Just not to get into very technical details, but currently the most large nuclear plants are built on the generation 3 or 3 plus type of reactors. There are very few, 1 or 2 in the world that have generation 4 type of reactor. The generation 3 is still using the uranium as a main commodity in order to fuel the reactor. However, generation 4 are based. There are different prototypes, and they are based on the different types of the commodity that goes, but mainly it's water that can be consumed. So they do have less nuclear waste, and they conceive to be more beneficial for the environment, and something that probably will be the next stage in the nuclear energy.
So let me pick up on that last point then, because you have this innovation that hopefully is less of a risk in terms of nuclear waste and hopefully in terms of accidents. It's one thing to create that technology. It's another to sort of sway the politics and the public opinion of it. So in your analysis, how do you look at that sort of tricky human nature question?
Yeah, no, absolutely. And nuclear energy has been around for a long time, and there's accidents that you mentioned, and Fukushima Daiichi accident is the latest that kind of put a lot of governments, including Germany, to kind of weave off from the nuclear energy, and Germany ended its nuclear operation of its nuclear plant last year. However, there's been some debate internally in the country and there is a technical capability of bringing those back up. However, the policies and the public opinions have been changing or shifting rather since then, and part of it is to the Russia-Ukraine crisis, part of it due to the 2021 energy crisis, where wind and solar were not that reliable and showed not to be that reliable. So the world learned that we actually need a baseload energy to be there and to balance the grid, and that's why the new technologies such as SMRs that are more secure. The idea is that a large portion of the construction can be happening on the plant rather than on site. Something that's been criticized a lot for nuclear projects, where whenever the technology is being exported on the site, there are delays, there's lack of trained labor, and the more capital is typically needed. Whenever this is being transferred back to the plant, there is more controlled environment, and then the core or the reactor can be put on the vessel, put on the ship, and be exported to pretty much anywhere in the world. So that brings another scale of exportability where it becomes easier to control those things, but at the same time, there's more secure core, because the SMRs are much smaller in their design and the nuclear plants, and there's ability to make it technologically more secure.
Right. Arkady, you have a wealth of insight around this entire sector and industry specifically, obviously here. When we think about, though, the first thing that an investor would need to know before they were to invest in any type of kind of nuclear, broader kind of economic ambitions that countries may put forward, and thus the companies that are the biggest beneficiaries of some of that kind of carve out of dollars that are thrust towards this type of energy, what is the first thing that an investor would need to know?
There are several things. That nuclear is here to stay, and nuclear energy would be part of the energy mix for the countries that currently have nuclear plants, but at the same time, it's expanding its scope. That we see more and more countries in the Middle East are looking and actively building countries in Africa. But at the same time, Asia is obviously the leader in the new builds, and China specifically, of adding more and more nuclear plants, or doubling their nuclear capacity, nuclear energy capacity. That's one takeaway. Probably the second takeaway, and this is being part of the commodity research group here at Citi and covering uranium, closely watching the trends in it. Uranium prices have been on the highs in the recent period, and currently trading above $55 per pound of U3O8, which is a raw uranium, which is typically cannot be used by utilities, but it is something that's taken by enrichers to enrich uranium and then can be used by utilities. So the price of the uranium has been rising in the recent time due to the concerns on the supply side, on the production, and the rising demand, shifting policies. So this is probably the second takeaway that investors can take away of the factors that can go in.
Really interesting stuff, Arkady. Thank you so much. Really comprehensive look at where we stand in nuclear energy and where we could be going. Let's keep in touch as all this stuff develops.
Definitely.
Arkady Gavorkin is Citi Commodity Strategist. Thank you.
Thank you.
We got much more coming up. Stay tuned. You're watching Yahoo Finance. Does anyone really understand AI?
Well, I'm sure there are experts who do, maybe the ones who are kind of building out the infrastructure. I actually think the whole concept of AI might be overly simplified, and I think there are so many different avenues you can go. Much like the internet, everybody compares it to 20 years ago. Look how many use cases there are for it, and there have been, and then the technologies that have kind of spurred from that. So I think the mistake would be to assume it's just this one monolith that we can kind of copy paste onto everything as a descriptor. There's probably a lot more that comes from it in different industries. And one of the reasons that I don't think AI is just a tech play, I think it's many sectors, actually the beneficiaries of it, that might end up doing a lot better because they can kind of right-size businesses that way.
Let's do a check of the market sponsored by Tasty Trade. So taking a look at stocks today, we are not seeing much change at all. The Dow and the S&P not even up 0.1%. The Nasdaq is up 0.12%. So just a little bit of movement here ahead of more economic data and earnings coming later in the week.
Speaking of earnings, with over half of the S&P 500 companies reporting so far, it's been mostly positive results this earnings season. 80% of companies have seen a positive EPS, earnings per share surprise. 64% have seen positive revenue, according to data from FactSet. Yahoo Finance's Inez Ferre joins us now with the details here. Hey, Inez.
Hey, Brad, and yeah, when you really look under the hood at where the sectors that have been performing the best, it kind of jives with what we have been seeing with stocks. So when it comes to positive earnings surprises, 6 of the 11 S&P 500 sectors have been seeing positive earnings surprises within those components. 5 of them are reporting year-over-year declines. Now, the ones that are seeing the surprises, well, no surprise here, we are seeing those with consumer discretionary stocks. We are seeing them with also technology stocks. Within, for example, consumer discretionary, you had CarMax that reported positive earnings surprises. You have D.R. Horton, which reported better than expected earnings. Ford Motor also reporting better than expected. These are some of the companies that reported the largest EPS surprises. Lennar as well. So really, the home builders are in there as well. Inside information technology, we saw Activision Blizzard and Netflix. And also, as far as industrials are concerned, General Electric, GE, reported better than expected earnings. When it comes to the declines, that goes hand in hand with, again, what we have seen with stocks that have been underperforming. I'm going to put up a year-to-date here on our Wi-Fi Interactive board so you can see that healthcare, some of the healthcare stocks, and of course the energy stocks, because remember, when you're looking at year over year, energy last year, oil was much higher than it is this year. So you had Chevron and ExxonMobil, for example, that reported declines when it came to their profits. In terms of the revenues, as you said, 64% of S&P 500 companies reported actual revenue estimates that increased. And so 7 sectors within the S&P 500 sectors, those are seeing year-over-year growth in revenue. And of those sectors being consumer discretionary, financials, those were the leaders. Again, energy, healthcare, those were the laggards.
And what about in terms of how the stocks have done relative to their surprises? What's been sort of the relationship?
Yeah, well, it's interesting because this report is saying that companies have actually been punished for their positive surprises, because if you take a look at the 2 days prior to reporting and 2 days afterwards, on average, there was a decrease in the stock price of 0.2% with those that reported positive surprises. And we saw that really when it came, for example, to Netflix. Netflix reported better than expected earnings, yet the stock had declined. Also with companies that reported negative surprises, well, those stocks were down by 0.7% in the 2 days prior and 2 days afterwards. By the way, this jives with analysis, and I wrote a piece on this on Yahoo Finance with recent analysis from JP Morgan, which said that you can expect that if there is an upside to earnings with these companies, that you can expect their stock reaction to be muted, because there has been a lot of buying going into these earnings, and also the guidance is key. Whatever they say on guidance, that will also have an impact on that stock price.
Yeah, most definitely. It's difficult to map it all comprehensively, but thank you for giving us a window into what's been going on. I appreciate it, Ines.
Thank you.
Let's get to airlines in particular and the numbers that they've been reporting and have yet to report. It's been a mixed picture for the industry this year, despite raised forecasts from the likes of Delta and American Airlines and soaring earnings as travel demand remains strong. There are still cost concerns and looming pilot shortages still lingering. For more on the state of the industry, we're joined by Helene Becker, TD Cowen Senior Research Analyst. Helene, it's always good to see you. We've heard from most of them. We still have JetBlue to report tomorrow. But kind of give us a state of play of where we are, given what we've heard so far.
Yeah, thanks for the question. I think what we're seeing in terms of demand is still very, very strong demand, but pricing has come off their peaks. And I guess it was just not sustainable that ticket prices would stay as robust as they were, number one. And number two, I think you're seeing a shift as well. We've talked about demand being strong domestically for 2021 and 2022, and then shifting internationally for 23 and 24. And that's what we're seeing. We're seeing very strong North Atlantic demand in Europe. And I'm going to say air quotes around, everybody seems to be in Italy this summer. And then next summer, we think we'll see strong demand on the Trans-Pacific for all markets except for probably China.
And so, Helene, with that kind of international travel focus that you were just alluding to a moment ago, who are the biggest beneficiaries from your coverage and perspective?
Yeah, exactly. That's why American, Delta, and United have done really well this year, because they have the most exposure, and United specifically is more exposed to international markets than any of the other airlines. JetBlue has a couple of flights, one to Paris, one to London, and I think they're heading Amsterdam next month. And then and that's it. Some of the other smaller U.S. airlines like Frontier and Spirit fly near U.S. markets, so they'll do Caribbean, Mexico, Northern South America. But that demand was part of last year's strength. This year's strength is really on the North Atlantic, and most airlines, with the exception actually of United, got rid of all their wide-body or a lot of their wide-body aircraft during the pandemic. And now with the demand shifting, they're having a hard time keeping up because they don't have the aircraft to put into service. And that's why you've seen American and Delta come out with some aircraft orders. And B, the other thing that we've seen in terms of demand for aircraft, a shift to leased in aircraft or buying aircraft off from the lessors, primarily because the OEMs are still lagging on deliveries.
Even with the strong demand environment, it seems like some of the travel headaches are still looming large. You ask passengers, and I mean, you're nodding in concert with perhaps a lot of the emotions and feelings of some of our viewers right now. How does that kind of add on a knock-on effect to some of the airlines right now that are either bringing capacity, continuing to bring that back online, or have code sharing agreements where they're sending passengers through some of the rigmarole of just how, if they miss their flights, where they need to rebook, who gets the credit, so forth? What type of knock on the stock does that eventually create, if any?
Yeah, no, that's a really great question. So it's just so frustrating for passengers, right? You plan all year long for your vacation, you're looking forward to it, and then something goes wrong the day that you travel. And it's not always the fault of the airline. Sometimes it's weather that creeps in, especially summer storms. Those are so unpredictable versus, like, we've talked about this before, Brad, you and I, the winter storms are almost always predictable. You know when you're going to get a big snowstorm, but with summer pop-up thunderstorms, you don't. And then there are downstream delays, to your point, and then passengers get frustrated. And I think the eventual effect will be, well, we sort of did that. I'm tired of all my flights being delayed or many flights being delayed. I'm just not going to take a trip that month or that week. I'm going to try to find a day of the week, like Tuesday, Wednesday, that might be less busy. And that does definitely impact results at some point. It's just right now, everybody, again, those air quotes, wants to travel. And until schools start to resume, and in some cases, especially southern tier of the US, they'll start to resume next week and the week after, you'll still see strong travel out of the Northeast. And we don't, that's not going to stop because those bookings are already made, but we've seen airports start to hire more people in an effort to help during the busiest times. And yeah, it just gets really frustrating. I get it. And, I always say to people, welcome to my life. I feel like for every that's on time or early, I'm going to pay for it with a late or canceled flight at some point in my future.
Well, it's funny, Helene, because as the airlines try to manage through it, just as an example, my son was flying this weekend. We got a message from the airline the night before. You might want to think about pushing your trip because there are thunderstorms forecast for the next day. Guess what? No thunderstorms, totally clear. The flight left on time. So I'd be pretty upset if I changed my flight with the anticipation that they, So it really does seem like a no-win situation, but it also seems like a situation that technology and more staffing could at least help. So that implies that the airlines are going to have to sort of spend more to address this, especially if the demand remains even close to the fever pitch where it's been.
Yeah, no, you're absolutely right. And the demand that we're seeing also is pretty equal to what we saw in 2019. And but the mix is different. It's more leisure and it's less business. And I think one difference is that people who are infrequent travelers get more stressed out than people who are frequent travelers and know that this type of thing happens, is, quote unquote, all the time. But the other thing, to your point, one of the things that technology could do for the airlines is enable connecting passengers to change the connecting hub. So if you're coming from mid-con, and let's say you're coming out of St. Louis and you're going to London, and your first choice was to connect over New York, if New York is going to have thunderstorms, maybe Boston doesn't, or Chicago doesn't. Maybe those storms have passed through. From the airline's perspective, they should be able to reroute you over a different hub, and their technology should enable either you to do that on their website or your iPhone or your smart device, or they can do it for you so that you don't miss a day of your vacation. Because to your point, just because there are forecast thunderstorms in my town, there may not be in yours. So they should be able to, with technology, make those adjustments. And that's something that I find interesting, because the industry was an early adopter of technology and using computers to issue boarding passes and check bags and so on. And then through the bankruptcies that they all experienced in the last or 2 decades ago, they lagged on updating their technology, and I think they're starting to think about catching up now.
Helene, just while we have you, we asked the CFO of Chipotle last week, and follow me on this one. We asked the CFO of Chipotle last week how global warming could impact how they think about their business. And that was with regard to kind of sourcing the necessary menu items. For airlines and the travel experience, I mean, you just talked about storms and more severe weather that they have to account for and communicate that to their passengers. And their passengers may eventually shift some of the travel schedules around unknown parts of the year where there could be extreme weather that derails their trip plans. Is there a broader kind of concern, or at least a thought or evaluation, that these companies are starting to give around global warming and how that changes what the customer propensity is to travel at certain times of the year?
Yeah, that's a really great question, because it's something that we've been looking at for the last year or so. And it's slightly different, well, in 2 different ways. One, exactly what you're saying. Markets like Seattle, for an example, that historically wouldn't have snow, it would have rain, but it wouldn't be so overwhelming rain that it would shut the airport down for an extended period of time. And yet last winter, you saw Seattle experience snow and ice. So you're definitely seeing that weather pattern shift that's causing airports that haven't had to deal with de-icing or runway clearing to have to start thinking about their investments in de-icing pads, de-icing fluid, and so on. So that's definitely one thing that we are paying attention to, and I think the airlines and the airports are starting to think about. We're seeing that at various conferences that's being added as a discussion item. So, yes to that part. And then the other part that I would say is with respect to sustainable aviation fuel. Every airline has some commitment with a producer of SAF to provide that to them over the next, say, decade, because a lot of those orders go out that far. And the government, through the Inflation Reduction Act, is incentivizing manufacturers, the energy manufacturers, to produce more SAF. And that's really the problem. Airlines are only 2% of emissions, but the longest flights are 80% of the total emissions. So wow. It's not really a like road transport is still the number one emissions. But that said, airlines are an easy target, and we need more sustainable aviation fuel. Every airline has said, we're there to buy it if you make it.
Right.
And you just have to do it in a cost-effective manner. The industry worldwide, Brad, to give you an idea of the numbers, uses 100 billion gallons of jet fuel annually. And the amount of sustainable aviation fuel that's out there right now is less than 5%. I don't even think it's 1%. So it's not even like it's in the ballpark of what's needed. And that's I say that's a 2025 to 2040 development. That's where you're going to see the industry go over the next 15 years.
Helene, always a fascinating conversation. Thanks so much for taking the time to really break down what you're tracking over at TD Cowen. TD Cowen Senior Research Analyst Helene Becker joining us this morning. Thanks so much.
Thank you.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from $30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance. Now to the work from home economy. Last week's U.S. GDP numbers came in stronger than expected, adding to the challenge from so-called noisy data and asking another big question. Why is consumption still as strong as it is? There is one possible answer: the boost from remote work. Axios' Emily Peck suggests the meaning of the weekend has changed. Yeah, it definitely has. And thanks to the rise of remote work, more professionals are taking trips and they're spending more on experiences. We've got Emily Peck, Axios markets reporter, here with us right now. Emily, great to take some time with you. All right, so if the weekend has changed, like how so? Because I mean, I still only get Saturday and Sunday off. I don't know if that's changed for other people.
Yeah, me too. Only Saturday and Sunday off. But what's changed is remote work and hybrid work. We know that most people are still staying home at Fridays and Mondays, and that has changed what they can do on the weekends, right? You don't have to watch the clock all day at the office on Friday and at 5 o'clock race to get on a train or a plane or hop in the car. You can get to your destination Thursday night work from a hotel room or, your friend's beach house on Friday, and then Sunday, you don't have to scramble back to make it to the office on Monday. You can stay another night. You can get in late Sunday, work from home Monday. It's just the greater flexibility has allowed a lot of people to travel more, and that means spend more.
And so, Emily, to connect the dots then, how does that feed into GDP?
So it feeds into GDP because what we've seen with the economy right now is that people are still spending money on services, on experiences, less money on goods. That spending hasn't held up as well, but we're seeing that spending on services really has held up. And part of that certainly seems to be this increased spending on restaurants, on hotel, on travel. And part of that is coming from, I believe, and the people I spoke to believe, from this essentially a structural change in how the economy works. If you can believe it, people are able to do more stuff, and that means they can spend more money. I feel like a lot of people point to the Taylor Swift concerts as a really great example. And you can see in the data how a Taylor Swift show coming to a city boosts that city's hotel revenue, for example, because people are able to travel and come in out of town and see a show and make it into a really big experience and spend exponentially more money than perhaps they would have, if this tour had been happening before the pandemic shifted the way we work.
Are people still kind of in concert, just going other places, working virtually, and just saying, you know what, I don't need an apartment in the city anymore. I'll just be a nomad, a digital nomad. Is that kind of still driving some of the spending right now? The digital nomad kind of culture, if you will.
Yeah, I think a little bit of that is happening at the margins, but really the big picture is people are keeping their apartments. They're living where they're living. They're just able to get out more and travel more. I spoke to, one guy who said, I think he went on something like, he went to 6 weddings, destination weddings in a year. Spent 2 weeks at, lake houses, just did all this stuff. And he said, I never could have done it before. I wouldn't have had the time off to make it to all these places. And we actually, Axios has some separate reporting, I believe, out this week on destination weddings becoming more popular. Sorry to tell you.
Yeah, I was going to say, in the past, that's an interesting framing. It allowed him to go to all those weddings. In the past, work was a very convenient excuse to not have to go to all of those weddings. But I guess, different strokes and all of that. I
digress.
How sustained, though, is this effect going to be? Because we know that an awful lot of companies are now making their employees come back to the office.
That is the question. We know a lot of companies, right, are trying to get people back to the office. And, time will tell. But I think we have seen the resilience of Fridays and Mondays as those stay-at-home days, those flex days. So I suspect that a lot of this is here to stay.
We shall see. Emily Peck, Axios markets reporter, will speak to you again about it, I'm quite sure. Thank you.
Thank you.
It is the end of the road for thousands of trucking employees as Yellow Freight shuts down all of its operations. That happened yesterday. The business was just short of its 100-year anniversary. It was once one of the biggest players in the industry. The often troubled freight operator received a $700 million loan from the federal government during the COVID-19 pandemic. For more on the story, Yahoo Finance's Danny Romero joins us. So, Danny, how should we think about Yellow in terms of how things are, trucked around this country?
Julie, it's been a rough few weeks for workers at Yellow Freight. First, they were fearing that they might lose their health care benefits, and now a bankruptcy is looming. I've checked multiple websites to see if the company has publicly filed, and they haven't just yet. But the timeline here starts on Friday. The company had laid off most of its non-union employees, and the company also stopped taking in new shipments last week. They just delivered what they currently had within their network. And then on Sunday, they announced all operations were shut down at noon. In a separate notice, the company plans to issue a public statement today on Monday, updating the state of the company and the operation. And the company has had multiple bailouts. I mean, including a COVID-19 loan given in 2020. The US Treasury now holds about 30% of Yellow shares, which if you check right now, those shares are about like $1 or so. So there's a lot at stake here. If Yellow collapses, more than 30,000 people, including 22,000 Teamsters, will be left without a job, Julie.
And Danny, while we have you, there's an impact to the taxpayer here as well. What are the details there from what you have uncovered?
This is not just bad news for employees, but also for the customers. This was also a way that people could send their shipments, goods. It was a cheap way to send goods. But on the taxpayer side specifically, the company received $700 million in a loan from the government, and which resulted in taxpayers holding 30% of its outstanding stock. And the company has not paid that back to the Treasury Department. And the company's balance sheet includes $1.5 billion in debt. What happened here? That is the million-dollar question. It's also a wait and see because the company hasn't publicly made a statement or filed for bankruptcy yet.
Yeah, well, we appreciate you keeping tabs on all of this and keeping us posted. We'll continue to track it, Danny. Thanks so much, our Danny Romero. We got much more coming up. Stay tuned. You're watching Yahoo Finance. What sector of the market do we not pay enough attention to?
Consumer cyclicals. I think we want to know where the economy is going. That's one of the best ways to find out where people are spending their money on. Discretionary purchases, so I guess consumer discretionary as well. Let's see where those are going, and that'll tell you a lot about how the consumer, which is 2/3 of the economy, is going.
After consumer technology drove the previous tech cycle, the Spear Alpha ETF's tracking the wave of growth that's expected to come from business to business tech spending. Spear Alpha is an ETF listed on the Nasdaq. The company behind it, Spear Invest, is an asset manager specializing in positioning investors in underappreciated opportunities in industrial technology sectors. This could be anything from enterprise digitalization, automation, space exploration. For more, we're joined by Ivana Dvilevska, Spear Invest founder and chief investment officer. So Ivana, we keep talking all about AI and the opportunities that we might see. We're looking ahead this week to earnings from the likes of Apple and Amazon. When it comes to industrial tech specifically, what do people need to know?
Well, the biggest theme that came out of this earnings season from the big mega caps that reported is that we're going to see a reacceleration in CapEx. And this was echoed by Microsoft, Google, Meta. Everywhere you look, 2H, second half 23 spending is supposed to be higher than first half. And similarly, 24 is supposed to be a stronger year than 2023 in terms of CapEx spend. And all of these CapEx dollars are going into investments to enable AI. So what we heard this time was even broader than GPU purchases. Companies are spending on CPUs, broader networking. So we expect that this will drive the next tech cycle going forward.
By how much are we expecting CapEx to increase?
Well, Microsoft is one example where the company is expected to spend $40 billion in the next year, and that was 25% above consensus. So $40 billion, just if you step back, is a huge number because these companies are not really that large, like NVIDIA, AMD, and Marvell are top picks in the semi space. They're going to see a pretty significant boost to demand.
To your point, most of the focus thus far has been on the semis. Where else do investors need to be looking?
So the next layer, we believe that we'll see a significant boost in spending is around data architecture, data infrastructure, cloud spending. So basically, as semiconductors sell chips to the cloud vendors, the cloud vendors in turn will sell those as services to companies. And then in that ecosystem, there is a number of companies that provide data streaming, data warehousing, cybersecurity type services that we think will really benefit here because they don't really need to make a ton of incremental investments. They're going to be using their existing products to enable this new wave of AI spending.
And so for the matriculation or the timeline as to when we can kind of hold these companies up to a report card to say whether or not their CapEx and the spending on generative AI or the infusion of more AI solutions into their businesses has been successful, what does that timeline look like from your estimation?
Well, in terms of the spending, companies are going to see that provide services and hardware are going to see it in the next 6 months to 2 years, right? So that's going to be pretty much early in the cycle. Then the next wave is going to be whether these products are actually successful. So it's going to be whether products like Office 365 Copilot is actually generating returns for Microsoft. And we're about 2 to 3 years out of that to see whether the AI products that are introduced are working in the market. But from early signs that we can see in terms of surveys, there was Microsoft Copilot, which was one of the early solutions for coders that was introduced earlier this year. There is clearly significant demand and there is clearly significant productivity improvement. It's just a matter of rolling this out to a wider audience.
And just quickly, Ivana, it sounds like you don't share some of the concerns out there about a bubble forming in some of these names.
Well, that's right. And the reason why we don't believe there is a bubble forming is because we're seeing a very typical pattern that you would see in any tech cycle previously. So first, early cycle semis recover, right? And then you see broader enterprise spend recover. And we're just seeing that this quarter. So the earnings from the mega caps told us that enterprise spend will be on the rise going forward.
Ivana Delevska, who is the Spear Invest founder and CIO. Thanks so much for taking the time here with us.
Thanks for having me.
Absolutely. And coming up, everyone, we have a lot to look forward to in the next hour with Rochelle Akufo. She's going to be talking to the SoFi CEO, Anthony Noto, at about 11:30 a.m. Eastern Time.
And then joining her live from the New York Stock Exchange will be Sweetgreen co-founder and CEO Jonathan Neiman. That stock's been under pressure lately, down almost 70% since going public in 2021. The recent dip coming after the company reported a loss on both sales and earnings in its second quarter. The stock is up today, though, on an upgrade from an analyst, so getting a little relief. Rochelle's going to cover all of that and more next.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Earnings season rolls on and the heavy hitters, Amazon and Apple, step up to the plate this week. We look at what investors should expect as big tech closes out its earnings. And SoFi shares are surging this morning after adding 584,000 members in the quarter and boosting its full-year guidance. We'll speak to the company's CEO this hour. Plus, investors weren't eating up Sweetgreen's earnings last week, but the stock is bouncing back today. We'll get a pulse check on that company with its CEO later this hour. But first, let's check in on the market action here. Still looking at green across the board here, though trading in a relatively narrow range. We see the Dow here up just about 50 points on the day. The S&P 500 there also up about 0.1% there. As we can see, we're going to have a bit of a mixed picture in tech this week as we're waiting for those earnings to come through, but also looking at energy and real estate leading the S&P. The tech-heavy Nasdaq there up about 26 points on the day. Bit of a mixed picture there that we'll be keeping an eye on as earnings season rolls on. Let's also check in on the Treasury market action as well. See what we're seeing there. We're seeing a little bit of a flight to safety here. The 5-year down about 1/3%. The 10-year also down about 1/3%. Similar story for the 30-year, though down slightly more by about 0.4%. Well, all three major indexes are edging higher on July's very last trading day. And while the market's momentum has been quite tempting this year, some strategists say investors might be too confident in the economy's recovery and ignoring signs of economic realities. Let's bring in Kathy Entwistle, Morgan Stanley Managing Director, to weigh in on this. Good to have you on the show here, Kathy. So first, let's talk about what's currently propping up the rally, because we know it started with tech and started to broaden it out. But where are we now in the rally?
Yeah, it's great to be here, Rochelle. Thank you for having me. It's a very interesting, dynamic that's going on in the markets right now, where a lot of people are feeling a little bit of FOMO because if they haven't been investing in this market, they've been missing out on a lot. So some of the things that we have seen are unprecedented in a sense, where 10 or so companies are making up, 35% of the return in the S&P 500. And this is what we're seeing, these bigger names, these heavier names, the tech names, carrying the indices. And that's something that we want to think about and just provide a little bit of caution for our clients. If you are in the large names that have had quite a rally, it's not a bad time to pull back. And those are sort of the things we're thinking about with clients, what to do in this market and how to best protect what they have and also help continue to grow to keep up with the pace of inflation.
And we do know that FOMO can sometimes overtake discipline, as you mentioned, when you see that you perhaps have missed a bit of the window in the rally here. But what risks should investors be keeping in mind if they're trying to jump into the rally right now?
Yeah, well, first of all, the markets are up pretty tremendously at the moment. And a lot of that is being driven by things that aren't traditionally what is driving the market. So basically with the COVID recovery and all of the cash in the market, we've got a tremendous amount of liquidity in the market, a tremendous amount of cash that is available for investing in the market, for spending and so forth. Right now, the rates are so high that a lot of clients are hanging on to cash and getting like a nice coupon payment back just by waiting. We're a little concerned about that in the long term because eventually rates are going to start to pull down. We don't think it will be for a while, but when they do, you will start to be hurt in a sense that you haven't taken out your duration a little bit longer. So we are encouraging clients to think about taking some of that cash or some of the money that's sitting on the sidelines and putting it into a little bit longer duration, fixed income, quality companies.
And so when people are thinking about this rebalancing that they should be doing, what should be on their checklist when they're thinking of what they should be rotating in and out of and how to not really chase the rally, but really still focus on the fundamentals?
Absolutely. And fundamentals is the key. So basically, value companies can be boring, but they can also be very protective. And also, if you have the dividends giving you a little bit income as you're waiting for those companies to grow. Also, growth at a reasonable price, we like a lot. So a lot of these companies, if you look at their growth, they've been tremendous. But is the price reasonable? Is the PE reasonable? It's very expensive right now to own some of these companies. So peel back. If you have them, peel back now and put that money into more reasonably priced companies. And we also will say that, a real bull market is going to run with new winners and, new leaders. right now, we're not seeing that quite yet. So we're just advising our clients to be a little bit more patient and to be thoughtful about where they invest. And maybe some areas like financials and some like consumer discretionary, some healthcare, energy, materials. Those are areas that we think should do well going forward.
And you did note some of the economic indicators, including things like rising credit stress, that are also still plaguing the markets at the moment. So, as you mentioned there, in order for you to believe that this rally is real, a bull market is real, what would you need to see happen with those indicators to say, yes, this is where it is from now?
Yeah, well, in actuality, the last like six bear markets has had quite a run towards the end, and then a big pullback and almost retest the bottom. So, if you've made a lot of profits in companies or growth in companies right now, there's no need to test those bottoms. Like that's why we're saying peel off now. Things that we want to think about too are the service industry is an area that has really kept the markets going, and the consumer has been spending. Now, this was a lot of the things that they're spending on happened a year or so ago. And the question is, will they continue to spend? Their real wage, income is not as high as it was a year ago. Interest rates are much higher, credit's higher, and we're going to look at their credit cards and the balances there too to see what kind of stress is there. In terms of corporations, we also think that they've been favored because the consumer has been spending, but we have to watch that and see if that's going to change their dynamics as well.
So certainly, don't just jump in there. Certainly a lot of nuance there as you broke down for us. Kathy Entwistle, thank you so much. Managing Director at Morgan Stanley. Thank you for your time this morning.
Thank you.
Well, early this morning, we got more color on the clash between the Securities and Exchange Commission and Coinbase before the SEC filed legal action against the major U.S. crypto exchange in June. Here to tell us more, we're joined by our senior reporter, David Hollerith. So, David, give us some context here.
Yeah, Rochelle, so as you mentioned, the SEC sued Coinbase at the beginning of June for allegedly operating an unregistered securities exchange. Now, in the SEC's lawsuit, they named 13 different cryptocurrencies, including ADA and SOL, which they identified as crypto security assets. Now, according to this story from the Financial Times from earlier this morning, the Coinbase's CEO, Brian Armstrong, said that ahead of launching the legal action against the crypto exchange, the SEC had asked Coinbase to delist more than 200 of its crypto tokens. And this essentially is everything but Bitcoin is what Armstrong was highlighting. And that is obviously far different from the 13 or so coins that are named in the lawsuit. And the implication here is pretty clear. It's Armstrong is sort of argued in the statements is that, if Coinbase had agreed with the SEC and hadn't sort of opposed it, and this case hadn't gone to courts, it would have essentially set a legal precedent for the crypto industry, which would have stilted it as far as how much it could grow in the U.S. So again, this goes back to the legal murkiness between whether or not a cryptocurrency is a commodity or a security in the U.S. And there's not a clear law decided there. The SEC believes that most everything except Bitcoin in the crypto asset class is a security. And this is obviously now playing out a series of lawsuits in the courts. The latest stage lawsuit of these we would bring up would be the Ripple case against the SEC. So it's also interesting that owning Coinbase stock at this point has kind of become like a regulatory bet for investors on the crypto industry, having sort of a more positive regulatory outlook in the near future. It's particularly interesting if you look at Coinbase's stock compared to Bitcoin. So there's also this ETF situation that's been going on. BlackRock and a number of other asset managers have filed for a Bitcoin ETF, naming Coinbase as a major partner in those offerings. And that, of course, needs to be approved by the SEC. But around the time of the lawsuit and the BlackRock filing, Coinbase's stock has significantly outperformed Bitcoin. And that's interesting because for most of its since its inception, for most of its trading history, Coinbase's stock has well underperformed Bitcoin. So we're seeing a huge outperformance over the month of July, and we're going to continue to watch that obviously on Thursday when the company reports second quarter earnings. And, we'll want to hear more about the regulatory side of things. It is interesting, though, that Coinbase, their financials are important as ever, but it does seem like the legal clash right now is really defining how the stock performs.
And still, as you mentioned, there a lot of uncertainty there and a lot of sort of regulation coming out of these lawsuits. So a lot to watch there. Appreciate you breaking that down for us. Our very own Dave Hollerith there. All right, time now for our trending ticker of the day. Adobe shares popping this Monday morning after Morgan Stanley analyst Keith Weiss said that the creative software maker has much more room to run. The investment bank now giving Adobe its highest price target on the street at $660. Now that's about 25% upside, fueled by optimism over its artificial intelligence strategy. Now Adobe stock has jumped 62% this year. Weiss wrote in a recent note, quote, "Greater clarity on AI-enabled products and the monetization roadmap increase our confidence in re-accelerating the Creative Cloud organic growth engine." Taking a look at Adobe shares, up about almost 4% on the day on that news. Right, all your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
What sector of the market do we not pay enough attention to?
Consumer cyclicals. I think we want to know where the economy is going. That's one of the best ways to find out where people are spending their money on discretionary purchases, so I guess consumer discretionary as well. Let's see where those are going, and that'll tell you a lot about how the consumer, which is 2/3 of the economy, is going.
Let's do a check of the market, sponsored by Tasty Trade. Still seeing a lot of volatility, though, still trading within a very narrow range here for the major indices. The Dow here up about 53 points on the day. The S&P up ever so slightly, up about 5 points on the day. We're seeing healthcare dragging on it a little bit there. That's the weakest performing sector so far this morning. And taking a look at tech-heavy Nasdaq, they're still up about 0.2% or 27 points. And let's take a look at shares of Nikola. The stock surging this morning after the EV maker inked a deal with J.B. Hunt. Nikola agreed to sell 13 of its Class 8 trucks to J.B. Hunt's subsidiary, J.B. Hunt Transport. The first deliveries are expected to arrive next month. D.A. Davidson analyst Michael Schlisky raised his price target on Nikola from $1 to $3 a share ahead of the company's quarterly report on Friday. The bullish hike also providing a boost to the stock today. Well, during the COVID pandemic, wastewater was used as a statistical measurement for the levels of coronavirus in communities around the United States. The high levels of the virus found in wastewater mirrored the high number of cases and hospitalization rates. And it appears that new data is showing similar overlapping today as it did during the first level of the Omicron virus. Let's bring in Yahoo Finance's Anjali Khemlani to learn more and why the data should still matter to you. Hey, Anjali.
Hey, Rochelle, that's right. Well, we actually are seeing an increase in that wastewater data, and that's the reason why we should be paying attention to it right now. The sampling showing that there could be what some are classifying as a late summer wave of COVID right now around the country. And so we've seen some pockets of the country, specifically, if you take a look at even New York, the entire state has seen an increase by about 73% in New York City of the sites that have been sampled, showing high levels of COVID. We're seeing also the CDC reporting hospitalizations up 10% week over week. And that is also based on what they are seeing in the wastewater numbers. So, it started in sort of early July, this slight uptick in numbers. And now you're seeing that translate into the hospitalizations. If you recall, that was similar to what we saw with testing, increased numbers of tests. And then following a few weeks later, we saw those hospitalization numbers go up. So now, since we don't have enough testing, the CDC is now relying on the wastewater sampling. And what we know is that there are thousands of locations around the country. It was initially set up in 2020. And so we have hundreds of counties reporting in. I know on the site, on CDC's site, I noted that California, New York, and even Nebraska have at least one site with 80 to 100% increase of the sample. So that just means that we do have COVID still circulating in the country, as we know. Currently, the XBB family of variants is the one that is of focus. And this, of course, as we get ahead of that fall booster conversation, which we know we'll be having shortly. So just so everyone is aware out there, stay tuned. COVID is still around, even though we'd like to forget about it.
And as you mentioned, there people aren't testing anymore, so we do still need to find ways to find these indicators as to what's going on with COVID. Appreciate you giving us that update. Anjali Khemlani there for us. Well, the big names in tech are continuing their rollout of second quarter earnings. This week, we have both Apple and Amazon to keep our eyes on. This follows the mixed reviews from Meta, Microsoft, and Alphabet, which sent investors speculating about the fervor and power of the AI rally and whether companies are truly in a position to capitalize on the new tech. Our next guest coined the acronym Matana, advising investors to drop Facebook and Netflix and focus their attention on some other names by adding Microsoft, Tesla, and Nvidia. Now, we still argues that these stocks lead and that AI has powered valuation growth. Let's bring in Constellation Research founder and principal analyst Ray Wong to discuss more. Always good to see you, Ray. So, still confident in the Matana stocks here, but as we talk about generative AI, what are the key differentiators in how these companies are mentioning and using it?
Yeah, there's a great difference between the folks that are actually using it, the folks that are actually producing it, and the folks that are supplying the tools to make it happen, right? And the tool makers, of course, are the NVIDIAs of the world with the GPUs, and of course, Google in the future with TPUs, and then Microsoft if they get into the chip game. And then, of course, we've got the companies that are actually doing the processing, which is in the cloud, right? So you see that with Google, Amazon, Microsoft leading that way. And then you've got companies that are using it like Adobe, Oracle, ServiceNow, and C3 security, those are the ones that are creating this AI empire. And we do see that, right? AI is driving the valuation growth. We were dead in November 2022. There was pre-Chat GPT, and then post-Chat GPT, you could see the tech starting to grow. So that's the big thing. But the second thing we discovered was ads are back. For the few companies that are left. And the ones that are actually growing, of course, here's where Meta comes into play, Google comes into play. And what we'll be looking for is Amazon and Apple. Apple doesn't break out its advertising revenues, but Amazon is now the third largest digital ad player in the market.
And we knew that there was this pullback in ad spending. Why do you think people are honing back into some of these stalwarts when it comes to eyes for consumers and ads?
Rochelle, it's a great question. I think what happens is if you've got the network, you've got the power to reach out to folks, and there are very few mass marketing capabilities left. And so Amazon has amazing reach because of commerce. Google has amazing reach because of search, right? And of course, Alphabet has amazing reach because of search. And then, of course, we're seeing what's going on with Facebook because of the network effects on Meta. Now, that also means other companies like Spotify, who are showing some growth. Yes, music isn't going to carry you all the way. Netflix subscriptions aren't going to carry you all the way. And you need to have multiple monetization models to be able to survive.
And of course, we have to talk about the cloud here, especially as we look at what happened with Microsoft's drop in cloud growth here. What is the story there, and how temporary is this? Is this part of a new normal, a shift that we should expect when it comes to cloud?
Well, the reason I say it's cloudy times ahead is because we're seeing some interesting usage of the cloud. A lot of companies just took their stuff and put it onto the cloud and hoped it was going to get cheaper. But now a new class of CIOs are doing something different. They're taking cloud hosting costs and cloud operating costs from maybe $1,000 a month and getting it down to $100 a month. And so we're about to see some rationalization in cloud usage, just as AI is picking up. And so we've got to see what happens if cloud contracts are coming down or if cloud usage is going to go down. And so Microsoft got through that. Amazon, we're going to watch very carefully on what their numbers are on August 3rd, and that will give us an indicator of what's going on. But Google didn't do too bad, right? They're flat at 28%. It is the summer, right? And we're going to see more pickup usually in the fall.
And of course, we have to talk Apple, whether it's, the becoming of that $3 trillion stock, or whether it's, what they're doing with their own sort of chip making there. What are your expectations, and have they really outperformed the way that you thought they would?
They've done really well given where the market is. There's an expectations that revenues are going to decline again in this quarter. It's been 2 quarters with decline, but we're still in a super cycle of refresh for iPhones. And it's not about the number of iPhone sales, and we won't see iPhone 15 sales if they make that announcement in the future. What this is about is how much can be made per iPhone, right? It's about the services revenue, and Apple's story around that is very important. It's because they've been able to grow the revenue per device. And that's an important number to look at.
And I want to talk Amazon as well, because we've talked about cloud, especially when it comes to Microsoft there. But what about Amazon as well and the growth story there? Because, we're hearing bits and bobs about their AI plans as well, but it's not really a big topic of conversation to the extent that we would have expected.
Yeah, so here's the interesting thing. There's been a lot of cost cutting at core Amazon. They've actually rejiggered their supply chains and their capacity and their warehouses, but they've improved the automation. And what they're able to do now is deliver at a package or deliver any kind of parcel at a cost lower than anybody else, more automated than anyone else, and more tracked than anyone else, which means they can start using AI machine learning internally to drive down the costs. And then the second piece is, where's AWS growth? And AWS right now is actually winning among partner mind shares. Large partners are actually being embraced by AWS, which wasn't the case in the past. And they're seeing that level of growth that's very, very different than some of the other partnerships that we've seen in the cloud. So we're looking at those 2 factors, core Amazon performance, and of course, what's going on with AWS.
Certainly fascinating to watch. Always great to check out all the Matana stocks with you. A big thank you there to Constellation Research founder and principal analyst Ray Wang. Have a good one.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Mike Wilson of Morgan Stanley has been bearish for quite a long time. And in a note, he just said, we've been wrong. Now, I'm not going to ask you about what he said, but I am curious, in a strategy making role, just quickly, how often you sort of re-examine your assumptions?
Constantly. Every single week we meet together as a group and we check in on how our thesis is playing out, new data. The trick is there can be a lot of noise day to day. So really the trick is really figuring out what's the actual signal, what has actually changed, and not getting whipsawed week by week. But indeed, we have gotten new information over the past quarter that has changed the view. The first is the enthusiasm about artificial intelligence and how that's for real and can boost valuations in advance. And then also in terms of the macro picture, we do believe that soft landing odds have risen given the data we've gotten recently.
Signs that the Federal Reserve's tightening cycle is nearing an end is leading to a softening in the US dollar, which could be a net positive for the S&P 500. Yahoo Finance's Jared Blickery has those details for us. Hey, Jared.
Hi there, Rochelle. Let's take a look at the S&P 500 first, then we'll take a look at the dollar, because what I want to point out, this is a year-to-date look at the S&P. It was in a trading range, and it just broke out at the beginning of June. That was with that non-farm payroll report for May. Now I'm going to show you the US dollar index over the same time period, and you can see something interesting happened at the beginning of June. It was in a trading range, and then it embarked on this down leg, and there were actually two into the middle of July. And this downdraft here coincided with a nice pop in equities. Importantly, that was the time that the rally broadened out. It wasn't just the mega caps anymore, it was the small caps as well. This is a Russell 2000. Over that 2-month period where the dollar was dropping, you can see small caps got a really big bounce there. Now, small caps tend to favor actually can deal with a stronger dollar, but a weaker dollar tends to help more stocks, especially those that are internationally, that derive their revenues from international sales. And in fact, Bloomberg did a study that those stocks do particularly well when there is a 6 to 8% drop in the dollar. We see an S&P 500 EPS boost a year later of 19%. So that's a pretty big boost right there. So let me take us to the US dollar index, and I'm going to show us a longer term chart. This is still a year to date, but you take a look at the 3-year here, and you can see, let me actually just convert this to some candlesticks. I'm going to put a 10-year chart. You can see we've been in this big trading range, but now we're below the upper end of that trading range. And so we don't really have a lot of support all the way down to the 90 level. That's the big level. So there's a lot of room for the dollar to drop here. And you began with a statement about the Federal Reserve. Yes, the Federal Reserve being done with its tightening cycle, and we don't know if that's the case, but if it were, that would be a tailwind for higher equity prices, and that would also mean less pressure on the dollar, because when rates are higher and the Fed is busy raising rates, everybody wants to rush into the US currency to buy those bonds, to buy those instruments that are yielding higher. Now, let me show you something visually with our heat maps here, something that's happened over the last 2 months as well. So this is a year-to-date look first of the S&P 500 sectors, and you can see the huge outperformance by XLC, that's communication services, houses Meta, houses Alphabet, also tech and discretionary, that's consumer discretionary. All three are the biggest mega cap sectors. But when you take a look at this 2-month period when the dollar was dropping, guess what? In the lead is energy. That is a more of a value defensive stock or a sector right there, followed by retail consumer discretionary. But then we have industrials joining the party. We have materials joining the party, financials, communication services. So this rally has really broadened out and is now including more of these. And so the thinking goes, if the Fed is pretty much done here, the US dollar can drop more and we can see more of this broad-based rally confirmed. Now, if that doesn't happen, on the flip side, if the Fed ends up having to raise rates farther than people expect, it's going to be the opposite, and that's going to weigh on risk.
And we know you'll be there to get us up to speed on all of it. A big thank you, as always, our very own Jared Blickery there. Hi, well, we're watching shares of SoFi today after the company added an additional 584,000 members in the second quarter and boosted its full-year outlook. SoFi also saw its total deposits grow by $2.7 billion and revenue jump 37% year over year. For more on these results, we're joined by SoFi CEO Anthony Noto. Good to have you on the show today. We're really still looking at the stock popping this morning. And it was interesting. We thought we were going to see the worst of the regional banking crisis and fintech really struggling in this second quarter. Does not seem to be the case for SoFi. Talk about how this quarter has fared for you.
Well, first, thank you for having me. Our 37% year-over-year growth marked our 9th consecutive quarter of record revenue. And for the first time, it was driven by our technology platform services business and our financial services business and not lending. Lending also performed well, but we've been on a march over the last 5.5 years to build out a complete one-stop shop for your financial service needs. And these other businesses are now importantly contributing to the growth at scale and soon to be contributing to the profitability as well. I think the biggest thing in the quarter that started to change for us is that the flywheel is really working between our increased brand awareness as well as the differentiation of our products. And that's driving great member growth as well as product growth. That larger scale is helping us drive towards profitability. We've been generating positive EBITDA for several quarters now, but we're on the precipice of being GAAP profitable by the end of the year. And our balance sheet is as strong as it's ever been, with $3 billion of cash after generating or adding over $500 million of cash to the balance sheet.
And regarding that target of achieving that sustained GAAP profitability for the end of the year, I mean, we still have some uncertainty here among consumers and especially very tight lending conditions as well. What do you think is going to get you there?
Yeah, it's really about continuing to execute on our plan. What we're seeing is market share gains. We have a very differentiated checking and savings account product. We're paying 4.4% interest if you do direct deposit with us in your savings account. We charge no fees. It's complete functionality from your phone. You can pay any way that you want. You could pay a friend. You can use a debit card. You can use a digital wallet. We'll even send checks for you. So it's complete functionality all on your phone. In addition to that, our forward lending products continue to be very differentiated in our mortgage business, as well as student loan refinancing, personal loans, and in-school loans. And then we have some earlier stage businesses like our credit card business and our invest business that are contributing as well. And then last but not least, we built our products on top of our technology platform, but we use that platform to actually drive revenue in a business in addition to the other financial services products. So we're half tech revenue and as it relates to non-lending and half financial services products.
And I do want to talk about some of the whole loan sales, because I know that in Q1, that was something analysts were concerned with not rolling off the balance sheets fast enough, but you disclosed $340 million in whole loan sales. Talk about that approach, because there are obviously still some whole loans still on the books here for SoFi.
Sure. So we have a three-legged stool for funding our loans. We have about $12.7 billion of deposits. We have over $3 billion of our own equity capital, and then we have $8 billion of warehouse lines. Because we have such almost $20 billion of funding capacity from those three sources, we could hold loans longer instead of selling them. We believe we'll generate a meaningfully higher return by holding loans than selling them at current prices. That said, we did do some sales in the quarter as it relates to personal loans and student loans to ensure that channel remains open for us, but we did it at very low volume at around the prices that are currently marked in our books. We're actually generating a better return than the marks on our book, which is helping us drive net interest margin so significantly. So we'll continue to look to maximize our return, whether it's holding the loans or selling them. Ideally, we would like to sell them over time, but because we have such capacity on the funding side of the equation, we have the optionality to hold them longer and generate that excess return, which we're seeing come through in today's results.
And of course, have to talk about student loans, because, you know, that's when SoFi was first kicking off. That's what most people knew SoFi for. And we knew that student loan debt repayments were going to restart. And then you couple that with the Supreme Court now also taking away President Biden's attempts at student loan forgiveness. How much of a boon is this going to be for SoFi? I mean, we see that student loan origination volumes were down 1% on a year-over-year basis. So what are the next steps of growth in that market?
Well, the great news is that we've been operating over the last 3 quarters without a robust student loan business, which in 2019 was our largest and most profitable business. Now it's relatively small. So our results today, as well as our outlook for this year, are not counting on the student loan business to contribute significantly. We do think there will be more of a recovery by the end of the year and as we go into 2024. But the results today and our outlook doesn't really reflect a changed view on the student loan market. There's about 40 million Americans that still have federal student loans, and they can come to SoFi and refinance those student loans and either get a savings on their interest rate, and if not on their interest rate, they can extend the term to lower their monthly payment. If they take that second strategy of extending the term to lower their monthly payment, they can still pay what they had planned on spending to pay it off at the same time, or have the flexibility of paying a little bit less. And if rates go down in the future and they want to refinance later, they can, because we don't charge any origination fees. There's no frictional costs or prepayment penalties. So they kind of have their cake and eat it too with the product. So we do think there will be a fair amount of appetite on both of those strategies. But again, there's about 40 million people in the United States that still have federal student loans, and we've refinanced less than 1 million people in our history.
There's certainly a lot of upside to be found there as well. A big thank you to SoFi CEO Anthony Noto. We see the stock here still being rewarded for that earnings data. Thank you so much for joining us this morning.
Thank you for having me.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
On July 20th, 32 nations arrive in the land down under to compete on soccer's biggest stage. Here at Yahoo Finance, we're taking you beyond the beautiful game. From sponsorships to broadcast deals and merchandising, finally, the world is paying attention. The Women's World Cup prize sits at $110 million. And that's up from $30 million since 2019 as their fight for equality continues. What will this year's World Cup do for that battle? And what's the economic impact? Will it truly be one of the most watched sporting events in history? We'll discuss all this and much more on Yahoo Finance.
According to the Wall Street Journal, Walmart is making moves to cement its position in the Indian market. The giant US retailer has paid $1.4 billion to buy out the remaining shares in Flipkart from Tiger Global. In 2018, Walmart paid $16 billion for a 77% stake in Flipkart. The Indian e-commerce company is privately held and one of the largest companies in India. It has a customer base of over 450 million and offers over 150 million products. Business spans brick-and-mortar stores, traditional e-commerce services, as well as online prescription services. With this recent purchase by Walmart, Flipkart is now valued about $35 billion US. Walmart has been selling off its international operations in recent years, such as its stake in the UK retailer Asda and its operations in Brazil, Japan and Argentina. Now, this latest purchase could mark a potential shift in Walmart's growth trajectory. According to the US Census Bureau, India is the second most populated country in the world, just behind China. Now, the latest investment in Flipkart may also be a way for Walmart to keep competing with Amazon, which has been building its strength in the country since 2013. Well, Sweetgreen posted its second quarterly earnings last week and saw its shares tumble as the salad chain fell short of Wall Street's expectations. However, digging in, the company did see its losses narrow from a year prior. Its Infinite Kitchen proved successful for the brand, and it raised its forecast for restaurant-level margins, saying that it would break even on adjusted EBITDA this year. Let's head over to the NYSE, where Sweetgreen's co-founder and CEO Jonathan Neiman joins us now. Thank you for joining us this morning here. Taking a look at what we're seeing with the stock reaction here, do you think investors are missing something here, or do you think the stock is being unfairly punished?
Well, I think we had a really great quarter. Overall, we grew 22%. We saw 3% comps with positive traffic, and we posted our first adjusted EBITDA profit as a public company. So I think our investors are pleased with the results. We're pleased with the results, and we have a number of drivers to continue to grow our comp store sales.
And when it comes to fast casual, obviously Sweetgreen, it's priced a little bit higher. All of these fast casuals are priced a little bit higher at a time when consumers are really looking for more of a value grab here. Are you seeing perhaps any trading down in how people are ordering or the types of things that they're ordering?
Our consumer seems very strong from all that we can tell. We've taken much less price than our competitors so far this year. We're running about 4 points of price with no plans on additional price this year. And on a relative basis, our competitors have taken significantly more price. So I think for what we offer, which is sustainably sourced food made from scratch every single day in our restaurants, I think you're getting a really good value that our consumers do appreciate.
And when you look at the chain's sales, weaker than expected, but what do you attribute that to? Is it sort of an overall sort of general consumer malaise when it comes to spending on fast casual? Is this more of a blip, or do you see this as potentially a trend that might require some price adjustments?
While we missed revenue by about 1%, a lot of it had to do with the mix shift in the business as our in-store channel continues to grow significantly. So while in-store is growing at a faster pace than delivery is today, they have fewer transactions per order. So the sales were slightly lower than expected, although grew 22% year over year with positive traffic. And in this environment is something I think we should be very proud of.
And certainly also looking at the restaurant level margins, as you mentioned there, those also improved. How are you able to manage that?
So it was a few things that we were able to do. One was sales leverage. The second was deployment of labor. So we were able to deploy our labor in a more efficient way, largely stemming from lower turnover and better stability at the head coach, which is our general manager level. We've also made a number of improvements to our supply chain. As we continue to scale and achieve some of our economies of scale as a business, we're able to maintain the cost of goods in a much better way, all leading to an increase in our four-wall margin, our restaurant level margin above 20%. And what we see are a lot of sustainable gains. So as you saw, we raised our guidance for the year in terms of margin, and look to continue to drive capital efficient, disciplined growth.
And of course, we knew we were going to hear a lot about AI during this earnings season and seeing some of these shifts to automation as well. Talk about this Infinite Kitchen and your plans to really perhaps expand beyond some of these current locations.
We opened our first restaurant featuring automation, what we call the Infinite Kitchen, just a couple months ago in Chicago, in a suburb called Naperville. So far, it's been incredibly successful. In our first month of being open, we ran a margin of 26%, and the store is still really ramping. So very encouraging. I think what's most exciting is the consumer experience is better. Consumers are telling us they're rating it better. They're telling us they're having a better experience, and that comes from perfect portioning, perfect accuracy, much faster service, with the machine able to serve up to 500 customers per hour. And our team members love it too. We're seeing less turnover. It's an easier and more enjoyable place to work. And so our plan is to continue to build on this technology and continue to build on this experience. We're opening a second unit featuring the Infinite Kitchen later this year. Next year, we'll begin slowly integrating it into our pipeline, and over time see this playing a major role in our future development.
And how else are you planning to innovate, and how much are you sort of setting aside for more R&D in things like perhaps generative AI or expanding the customer experience using automation and AI?
Yeah, innovation's always been at the core of what Sweetgreen does, and so there's a number of things that we're working on. We talked about automation being a huge driver. We have a number of other formats that we've tested that are going to be growth drivers for us. One is our drive-through concept, also in the Chicago area, called Sweet Lane, which we're planning on building upon. Another is our pickup-only kitchens, which we piloted also late last year, which has been very successful. Beyond that, a lot of innovation in the menu. So while Sweetgreen started more as a salad company, we've expanded our menu and our occasion to broaden our consumers. So you're seeing a lot more hot and hearty, protein-forward dishes coming out, which with a lot of success and more to come there, and as well as some innovation on the digital and loyalty side. This quarter, we also launched our loyalty program called Sweet Pass, which has a free program of rewards and challenges that anyone can sign up for, as well as a membership program where for $10 a month, you can get $3 off every day. We're seeing some really good growth on that program with some nice incrementality of our low-frequency users who sign up and become frequent users through that. So we're going to continue to accelerate the pace of innovation on a number of these different verticals as we look to build the next generation of healthy fast food.
We know in the DC area, we love us some Sweetgreen, so looking forward to seeing some of those innovations in the restaurants over here as well.
Well, thank you so much.
Congratulations on your quarter. You're very welcome.
Great to be here. Thank you.
A big thank you there to Sweetgreen co-founder and CEO Jonathan Neiman. Thanks so much. All right, well, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Where will CPI be a year from now?
Well, I think if we were going to almost play the game of base effects, like CPI was flattered this June because of last year, we hit the peak. Maybe a bit higher if you get a bit of a stabilization in commodity prices and energy prices, and then you don't get as much relief on some of the stickier parts of inflation. But I think for the most part, hopefully we'd be stabilizing, but we haven't been focusing on that as much, and as you and I have talked about a lot, the Fed hasn't been focused on that either. They've been focused on other metrics that have been a little bit slower moving to the downside. So I think it ultimately depends, in my view, on the labor market, how strong wage growth is if we do start to see a little bit of a loosening. If you don't, you probably have a scenario where you're in a little bit of a higher inflation plane.
As the Republican presidential race heats up, one underdog is making some headway in the polls. Taking a look here at Vivek Ramaswamy, getting some praise from Republicans, and while he most likely won't win any states in the primary, he could be a rising star in the party. Joining us now is Yahoo Finance senior columnist Rick Newman. So Rick, what should we be keeping an eye on here?
Well, this is horse race stuff. Ordinary people who don't really think about the election until a month or so before the voting, they don't really need to pay attention to this. But you do look for changes in the standing of the candidates. And Vivek Ramaswamy has now kind of jumped into third place. Now, these are very low numbers. He's still polling in the single digits among Republicans. But I think notable that he's actually doing better than people who have a lot better name recognition, such as Mike Pence, the former vice president, Chris Christie, the former governor of New Jersey, Nikki Haley, who was an ambassador in the Trump administration. I mean, he's sort of jumped ahead of those people. So that tells you something about what he is saying to voters seems to be resonating. For what it's worth, he is pretty Trumpy. He is riding on sort of this anti-woke sentiment you hear from Ron DeSantis, the governor of Florida. And he says that if he were elected president, he would pardon President Trump of any crimes he may have been committed of, which is sort of a way of splitting the baby. It's sort of a way of saying, I stand with Trump, but here's a nod to reality, the fact that he is under all these legal charges. So again, he's probably not going to be the candidate, but part of what he is saying is getting through, and he's only 37. So this does tell you something about who might be part of the future leadership of the Republican Party.
And he's certainly been making the rounds here. But I mean, you have to wonder if he's very Trumpy, but you also already have Trump running. I'm trying to understand then why he'd be growing in popularity when you already have Donald Trump in the running.
Well, not all Republicans automatically vote for Donald Trump. So the Trump base within the Republican Party, it might be half of all registered Republicans. So what about the rest? What about what you might call the other half of the Republican Party? Some of them, maybe they would consider Trump. A few of them are never Trumpers. So what a lot of these candidates are trying to do is trying to figure out how to kind of like create a Venn diagram among the people who are loyal to Trump. But let's say Trump ends up not being able to finish the job as a candidate because of legal problems. And then other people who are Trumpy, but they kind of want a Trumpy candidate, but maybe not Trump himself. So you've got several candidates really just kind of tripping over each other, including Ron DeSantis, Mike Pence, and others who are trying to be Trumpy while trying to establish some daylight between themselves and Trump because of Trump's legal problems and other things. And it's just very difficult to do given the weird makeup of the Republican Party at this point. So Ramaswamy is, he's maybe establishing just a wee little bit of daylight between Trump and himself.
Indeed. Interesting. We'll definitely have to watch how this is all playing out. Always great to get your take here. Our very own Rick Newman. Thanks so much.
Hey, Rochelle.
All right, well, let's get you a final check of the markets as we head into the noon hour. Still looking at positive gains, but now, as you can see, relatively flat across the board. Lost a lot of the momentum here. Looking at some session lows for the morning, we see the Dow here, as you can see, just barely turned negative there. We're also looking at the S&P there, also right on that flat line as well. The tech-heavy Nasdaq there, as we can see, also relatively flat there, just up about 10 points on the day. Well, that does it for now. I'm Rochelle Akufo. Stay with us on Yahoo Finance. Much more coming up today.